Hi everyone. I hope I'm audible and visible to all. May I get a quick confirmation over the YouTube chat box? Am I audible to you? Are we in sync? Come on, quick confirmation. Awesome. Audible and visible. So great. Welcome you all to the Advanced Audit and Assurance Grant Revision for June 2024. And today we are going to revise the topics of audit, and that is going to include your direct theory topics like what is professional skepticism, what is auditor's liability for laws and regulations, what is the auditor's responsibility for fraud. So all such questions where we guys, get stuck in the direct theory or, those theory points that we have to write in application based questions also. So when I start with an application based question in AAA, I first have to state the ISA, right? And sometimes we feel lack of words in typing that ISA out. So that is what we are going to cover today in this session. And I'll try to tell you that how do you attempt your audit procedures, how do you attempt your audit evidence questions, how do you attempt your audit risk question, review and reporting question. So we won't be doing questions today, but we will be discussing the strategies, we will be doing the concepts, and we will be typing them out. So by the end of this session, you guys will have a very crisp notes with you, which I will make right in the session in front of you. And after the session, once we get over, I'll share that PDF in the description box. So first of all, before we begin, kindly share this YouTube live with as many friends of yours as possible who are attempting AAA so that we can have a good confidence and a good energy levels attending this session with as many classmates as possible in the session. So without any further delay, let's get started. I hope everyone is doing fine and you guys are enjoying your advanced audit and assurance studies. I know this time is a little, when we are anxious that this paper has a really bad pass percentage, and then people are like, it is very difficult. But then when you look at the questions, it seems more terrible because sometimes we're not able to match the answer at the back of the kit. So that is something that I want to tell you that don't worry about it. Now, what we can do is you are attending this session. So this was the best that you could have done. So you're attending it, you're doing your best. Okay. Nothing else can be done from our part, apart from doing revisions, apart from doing pre-June mock by ACCA and giving one mock paper in timed environment. Okay. These are the three things. If you're left with these three things, just do them before the paper and you will be done. Okay. So don't take too much load on yourself. Be calm, be, I would say, be easy on yourself. Okay. Take your sleep. And without any further delay, now let's get started with our session. So here is the Word file. I hope everyone can see this Word file as well. So this is what we are supposed to do. These are the direct theory questions from my AAA June 2024 Grand Revision. So you all know my name. My name is Tashwita Gupta. By chance, if you are new here, I teach SBR and I teach the FR paper as well of ACCA. And I've recently, like from March quarter, I started teaching advanced audit as well. I've been teaching advanced audit 2 years ago, and I've had students who got ranks in advanced audit. And the most recent quarter, which is your March quarter, one of the students got world rank, that too seventh around the world, and All India rank 3. So that is my introduction. Now I would start with what is professional skepticism. Okay, before I dive into the concepts, we all know the format of the paper, right? The first question is going to be from audit risk or risk of material misstatement. Now, before I begin with the direct theory questions, let me give you some like format related tips. So here in the question number 1, I got this from a lot of students that, ma'am, which type of questions do you predict in the paper and all those things. I would just tell you that there is no prediction. But if you have guys seen the March June 2023 paper, I gave this paper as a mock exam for my students. So all the students who are enrolled at TG Professionals, you guys have attempted this as your mock. So in this first question, you must have seen they asked a new kind of risk of material misstatement where they said that write the ROMM about the inventories only. So usually what we are supposed to do is we are supposed to identify the risk and explain those risks in our own order, and you are supposed to prioritize the risk also based upon, for example, detection risk is your first priority, new audit client, right? And all analytical procedures, these are your prioritized risks when we have a general kind of a situation where they say evaluate and prioritize the audit risk. But if you see this March June 2023 paper, these guys have asked you ROMM just on inventory. Now that is something which is new, so I must recommend you that you guys check this out. March June 2023 paper, ROMM inventory. Okay, so that is a new kind of risk question. And then in the first question, always we have risk. We can also have business risk. We can also have audit procedures. And something related to like a direct theory question can be asked here. A DTQ can be asked here. So, for example, what is transnational audit? What is joint audit? What are support letters? What is an engagement letter? So, all these questions are direct theory questions. Or what are the responsibilities of the, for example, what are the responsibilities of the auditor with regards to laws and regulations? So something like that can be there in question number one. Okay. Then in question number two, what can we find? In question number two, most of the times you find a requirement which says discuss the matters or evaluate the matters to be considered in the particular question, like in the case study, and also give some kind of evidence together with it or procedure. So any one of them, mostly evidence, right? So that is the second question mostly, and this is all from your IFRS knowledge. So how do you answer matters to be considered requirement is what I will discuss today as well. So how do you actually, follow that approach of materiality, treatment, and then talking about its impact or the risk based upon which level of, you can say, which stage of audit we are in. So that is our, you can say, the second question. And together with it, you can find the, again, direct questions can be there. There can be, you can say, the audit procedures or evidences mixed. Then question number three, this most probably has review and reporting in it. Okay, review reporting is there. And you can find other assignments also here. So other assignments can also be found here. It can be in question number two also. So there's no hard and fast rule that where we will find other assignment. The only hard and fast rule which we have is for our question number one. Question number two and three are like, can be shuffled. So review reporting and other assignments. Now in review reporting, one very common kind of requirement is there that please critically appraise the audit report. Correct. So how do you critically appraise a report? You talk about its paraphrasing, you talk about its format, you talk about the sequence of the paras which are placed. Sometimes what has to be put in MURGC, they put it in EOMP. So I was just doing Super 20 questions with my students. We just ended them yesterday only. So there were so many questions where we were, asked about that there was a material uncertainty regarding going concern. But as usual, the auditors, they have put it in the EOMP paragraph or CAM paragraph. So that is something that we are supposed to question. So all these things are going to get tested in your paper. So you have a nutshell and a framework that these things can be tested and will be tested in my exam. Now going forward, we all know that the first question is for 50 marks and here you have 10 professional marks. Now I get a, most of the students keep on asking me this, that ma'am, what are the professional marks for? That why do we have professional marks in the whole world? Why we have to, uh, you know, do the professional marks thing. So I would say that professional marks are for your format. You write introduction, you write conclusion, you correctly calculate your materialities, you keep a logical flow in your answer, like you're not too, you can say, repetitive in your points. You're not putting what is there in the case study again and again, or you're not giving background a lot. And if you've written something already, then you're not repeating that point. So that I would say is being professional. So just imagine that you are an audit manager and tomorrow you have a meeting with your senior. So you will, of course, keep your speech very professional, and you will also, try to not repeat your points. And you will also try that, okay, I add value with each and every point that I say. So that is something what I mean by the professional marks. Correct. So now let's get started with our direct theory questions. Are we all ready? Give me a quick thumbs up. Are we all in? Come on, how's the Josh? Are we high on energy or not? Let's get started. Yes. All in, all audible, visible. Great. Okay. What is professional skepticism? What is what is professional skepticism? So professional skepticism, I would keep keywords with me. It is an attitude, first of all. So I'm going to write at the keywords for you. It is an attitude of keeping a questioning mind. So come on, you need to keep a questioning mind. Why do you want to keep a questioning mind? Because when you are collecting evidences, yes, you are collecting evidences, you need to be skeptical. So how do I need to be skeptical? Because I need to see whether the evidence that I'm collecting is sufficient and appropriate or not. Then I need to be skeptical with regards to any situation where there will be a conflict in evidence. So I need to be skeptical in that case also. Please let my spellings be. I am a very much typo mistakes are done by me. So don't mind that. Okay. So conflict in evidence, that is something that we would say that we need to be skeptical about it. For example, you can see in the case study that the auditor had some indicator of money laundering in the case study, but then him being him and you being you, you're supposed to point it out that he was not able to imply that maybe this particular client is involved in money laundering because he was having a cash intensive business. That means you lack professional skepticism. You were supposed to take that as an indicator. So God is not going to come and tell you that maybe there's a possibility of a fraud because this client is hiding something from you, or there maybe is a fraud because employees are saying something else and the chairman is saying something else. So you are supposed to apply your professional skepticism, figure it out that maybe there is a possible fraud. So you need to be skeptical in case you figure out any indicator which suggests that there is a possible fraud. So this is what we mean by professional skepticism. And professional skepticism helps you to identify the material misstatement which are arising due to error or fraud. So it's a weapon that you use. Okay, this is a weapon which auditor uses in all the situation. So audit is not tick the box approach. Audit is like a very lenient approach which you have to apply. I would say tailoring to each case, tailoring to each client. So skepticism is your weapon. Now, if I say that I have a standard rule that once I go to a client, these are the procedures that I follow. In that case, you have to be a blind person and you have to do whatever it takes to do the audit. But when I say you have to apply your skepticism or you have to apply your judgment, that makes audit subjective. Now, please take on these words that I'm saying. It makes audit subjective. What is subjective? That it varies from person to person, it varies from case study to case study, question to question, right? So this is what we mean by professional skepticism. And if something is asked, these are the keywords that you can put in your definition and you can make your points ahead of it. Moving forward, what do we have? What are the responsibilities of the audit committee? Now, come on. This is part of your corporate governance. That what are the responsibilities of the audit committee? What are the responsibilities of audit committee? First of all, we should know that audit committee is, made up of all NEDs. Who are NEDs? These are non-executive directors. So these people are independent people. They're not involved in day-to-day operations of a business. So they are very independent. They're coming from another companies. They're directors of other companies, and they don't care that what is going on in your business. So they have no self-interest vested in that business. That's why they're considered to be independent. So all people in an audit committee are NED. So if in a question you figure out that, the client is having, let's suppose it's given that the client has only one NED in audit committee, and all the other, let's suppose four people are executive directors. So you will put a point in your business risk and in your audit risk as poor corporate governance. So this audit committee frames corporate governance. So if they do not have good people in their corporate governance, that means the direction and control of this business is weak. Because what is corporate governance? What is corporate governance? Or what is known as governance? Governance means how a company is directed plus controlled. So if you see that client has only one audit committee, your point implication will be poor corporate governance. So that can turn out to be your business risk as well as your audit risk. Then, what is the duty of an audit committee? So, audit committee oversight companies' relations with the external auditor. So, relations are maintained. It's like a bridge between the entity and the external auditor, correct? So, it is a bridge between the company, the client, and the external auditor, which will be us in the case study. It recommends appointment, reappointment, and removal of external auditor. So, who is the person who controls external auditor in a business? It is the audit committee. So, to whom are we answerable, accountable? It's the audit committee. So, audit committee is someone, if we have any issue, first we reach out, when we say reach out to those charged with governance. Whom am I referring to? Am I referring to God? Those charged with governance is audit committee. So I need to refer to them whenever I communicate anything which happens in an audit. For example, key audit matters. When I, give them significant audit findings. Now that goes to audit committee only. So audit committee recommends reappointment and removal of external auditor. Then it also reviews the qualification of external auditor. So as our ethics point of view, I'm sure you guys have done your AAA to another level. We always keep on saying now that check the qualification of internal auditor, check the qualification of component auditor. But who in the world is checking your qualification if you are the external auditor and you are appointed as an auditor of a firm? It's the audit committee who keeps a check on your qualification, whether you follow code of ethics or not, and what is your reputation as an audit firm. Then they also make the policy on non-audit services. That means if a business needs non-audit services, when we say as an auditor, if someone asked me to advise them on their IT system, I'm an auditor to a client, and they also asked me to advise them on their IT system, which is related to reporting, financial reporting. So I always say, this is non-assurance services. So if it is a listed client, I would provide it or not provide it based upon the rule under the code of ethics. So similarly, entities also have some self-respect. So they will also actually make a policy that whether they are supposed to ask for these non-audit services or not. So this policy once again is made by the audit committee. And as a safeguard, when I say that discuss with TCWG, whether you want to provide this particular audit service, non-audit service or not, then again, I discuss it with audit committee only. So this is what we mean by audit committee. It is comprised of NAVs, and these are the responsibilities or roles of audit committee. Company's relation, appointment of the auditor, qualification of the auditor, and policy of non-audit services. Are we all clear? Come on, quick thumbs up. Let's move ahead. Yes, all clear? Good to go. Next is, what is ISQM 1? So this was ISQC 1 previously, but now we call it as ISQM 1. So that is basically our, you can say, standard on quality management. Quality management. Now, what is quality management? Have you seen that particular requirement in so many questions where they say that given in the case study, figure out or identify ethical issues and quality management issues? We've seen such a requirement in the case studies. Yes. Have we seen them when they talk about ethical issues and quality management issues? Yes. So what basically, yeah. So what basically are they talking about? They're talking about ISQM 1, International Standard on Quality Management. Now, please read this. This paragraph that I've written, this whole write up that I've written is my own write up. Okay. This is not something that I have just copied and pasted and showing it to you, but this is, I've written in simpler words for you so that you digest it and you are able to write as it is in the paper. So audit is based on judgments. We all know this. We just discussed this, that audit is based on judgment, and it is based on application of professional skepticism. These are the two weapons of our audit process. And we do not follow tick the box approach. So you all know this is my language only. We do not use tick the box approach. We are not conventional people where we have you can say, where we have rule based audit. We have, we have voluntary audit. We have the audit where things are not rules. So that is why it is the application of judgment and skepticism across the variety of clients is relative. So when I apply my judgment and skepticism, of course this will turn out to be relative, right? So what is risky in client A might not be risky in client B. So maybe client A has a foreign subsidiary. So I have a particular set of mindset when I'm working on that subsidiary. But that same mindset maybe cannot be applied to a company who does not have a subsidiary abroad. So that is why I say audit is relative. So it becomes really difficult to make some quality control procedures. Now, what are these quality control procedures? Are they just based on one case study or one question or one client? No. If I am an audit firm, if tomorrow you guys qualify ACCA, most of you are giving AAA as your last paper. So tomorrow, if you guys qualify ACCA and you plan on to open your own audit firm in UK, so in India it won't work, but let's suppose you open it in UK and you get UK clients and you have that practice certificate, okay, and now you're auditing the clients. Now, you as a firm will have some procedures. As audit firm, you will have some mindset through which you will manage your quality across the clients. So across as many clients as possible. So I'm not saying that only one client, one question, but as a firm in yourself, you are going to have such mindset, such procedures, such systems via which you're going to control your quality. So what we do is to maintain the quality of audit at all times, ISQM 1 suggests a system of quality management. So what is a system of quality management known as? It is known as SOQM, System of Quality Management. So we have one generalized system of quality management, which we tailor according to the client. Come on. We have one generalized system of quality management, which we tailor according to each and every client. Now, the first system of quality management, which we are supposed to do, is firm's risk assessment process. So you guys must have heard this, no? The elements of quality management. How many of you have heard this? Elements of quality management. We've heard this, no? And many people actually use this in their direct theory questions. Elements of quality management. So you must have seen this in your pre-June as well. Pre-June mock exam. So what is here in quality management? The first is firm's risk assessment process. Now all must listen to it very, very carefully. Firm's risk assessment process. So as I said that as an audit firm, you have a process of risk assessment. What risk assessment I'm talking about? The firm must design and implement, okay, a process to identify the risk. Which risk should I identify? The firm must consider its size, environment, specific situation, network, and external service providers. So I am talking about the risk assessment of your own company. So when I talk about quality, let's suppose something happens which is absurd. Suddenly it happens to the audit firm and it was already auditing some client. Now the quality of your audit will reduce. So you are not just, you're not just supposed to think about the risk of the client only. You have to talk about the risk of yourself also. You are also a company and you are also subject to risk. Yes, we are also subject to risk. And we should consider that risk in our whole process of quality management, so that whenever we have a risky situation, we still have enough staff available, we still have enough funds available, so that we can peacefully audit our client, so that our audit service is not any way or any time hampered. So for that, we need to keep a design and implement a process to identify the risk. The firm must consider, you should consider your size, your environment, your specific situation. Networks means in all what kind of clients you have, and do you get your services from external service providers? Because if you get that, that means you need to keep a good supply chain. If I get my audit experts are there, many audit experts are there, or many services within the audit process are outsourced. So I definitely need to keep a substitute available with me. What if sometime or some day in future that audit expert ditches me? So I should have a substitute available. So for that, I need to design and implement a process to identify the risk, keeping in mind my size, my environment, my specific situation, the network, the external service providers. And we should keep this ongoing. Okay, this is an ongoing process, it is ever changing. You can't say that today I identified my risk and I was not risky, so let's keep thumbs up and move ahead. No, every day, every month, every year, you need to keep a recheck or monitoring of your risk assessment as an audit firm. That's your first element of quality management. Not just talk about the risk of your clients, but also talk about risk of the firm itself. Then governance and leadership. Now, come on, what is governance and leadership? Tone at the top. What is this tone at the top? You know about culture, culture of a firm. If culture of the audit firm is, I've heard about a digital marketing company, and they say that if the uh, client goes, like if you are a graphic designer, you are a video editor, and due to you, if the client goes, then you will be laid off. So it's like if the client goes, you will be laid off. So what is the culture of that company? The culture of that company is client driven. The culture of that company is all about revenue. The culture of that company is that profit is greater than anything else in the world. So as an audit firm, your culture, that means the culture at the top management, who sets the culture? The CEO sets the culture. The chairman sets the culture. Those people should focus on quality of audit, on ethics rather than client retention or engagement profit. So what should be my, you can say my motive as a firm? My motive as a firm is quality audit, ethical requirements being met, not client retention. I don't care if the client goes. So if my audit firm, let's suppose I'm an engagement partner and my audit firm is very okay if we lose a client. My audit firm is not going to bash me if they lose a client because of me. Then I'll be very brutal with the client. I'll be very ready to take stand against the client. So, as an audit engagement partner, that is what is needed out of you. You are supposed to be brave. You are supposed to take stand. So, as a consequence of a good governance and leadership, engagement partners will confidently challenge the client's judgment. So, why most of the engagement partners bend to the needs of the client? Because we are too much dependent on the client. We need the fees. We don't want to lose the client, and we are like, okay, whatever the client is saying, do that. So, as an auditor, you're an independent person. You're getting your audit fees, and you don't care whether this client is going to be with you in the coming future or not. You are supposed to not care about that, and that would only and only happen if the culture of your firm is quality driven, ethics driven, and not profitability driven. So, what are the two quality management features that you've done till now? First is that my firm should also have some risk assessment procedures to maintain quality at all times, so that we know when our resources are available, when our audit experts are available. Second is that we should also have some kind of leadership and governance where the tone of the top is ethics driven, quality driven, and not profit driven. Then what's my third quality management element? Relevant ethical requirements. So as an audit firm, I should train my employees. So if in a case study you find that the audit senior says that we won't train our audit junior because we don't have that much time and energy. That moment you are going to point finger at that person that how dare you said that. That is against quality management. If you will not train the audit team of your firm, then how are you going to maintain your ethics? You must have seen in case studies that a junior, he started, he was given a gift and he accepted the gift from the client and came back jumping to the audit firm. And when we used to say in the case study that, oh, how stupid a junior he is, he needs training. So when you say he needs training, that means you have not provided him the training. So you are at lack. Your quality management is a problem here. So train the employees regarding the faultless compliance with the code of ethics. Then you will also consider that whether component auditors follow ethics or not. So you should have that mindset in your company only. You should train your employees that if you are relying on the work of any other person, you are supposed to see whether they are ethical or not. We as an audit firm provide you ethical training, but are those people provided ethical training? Then sometimes ethics go beyond the code, international code of ethics, that is IASBA. So in ACCA, we follow International Code of Ethics. But if you talk about other local bodies, if they are not ACCAs, maybe they are CPAs, they are Indian CAs, Pakistan CAs. So they are different, you can say jurisdiction. We have different regulation. So ethics go beyond the International Code of Ethics. Then ethical requirements in the case study are linked with the quality management. So you must have seen that in our question, in our AAA question, most of the times they ask us quality management issues and ethical issues. And even when they talk about professional issues, when they talk about professional issues, they are only referring to quality only. So this is all like interlinked. You can't bifurcate that what is ethics and what is quality management. So if I say ethics, if there was a self-interest threat, that is ethical thing. But if there was a quality management problem, like we were time pressured or we didn't have enough resources while doing the audit, or for example, if I talk about bad quality audit, they didn't do test of controls. I was doing one question in Super 20, I still remember. That question said that we previously did test of controls on this, some part was there, I think payroll. The payroll had already been tested previous year. So based on that, we never tested it in the next year. So that is something which is bad quality audit, right? So quality issues, ethical issues go hand in hand. So in a particular case study, you will figure out where there are ethical issues and where there are quality issues. Then what we have in the fourth is acceptance and continuance of client relationships. So what we are supposed to do, we are supposed to assess the integrity and ethical values of client and its management. So for example, when you accept any client, what process you should have in mind in your firm. So your firm, before accepting a client, should look at the integrity of the management. So it's not always that we are supposed to check whether we are able to do the audit of this firm, what is the fees that we are receiving. We need to see that the management, the core people involved in my client's business, are they truthful people? For example, if the director of that company is involved in money laundering, don't accept that client, because if you accept that client, you are getting dirty, you are compromising your quality. So you need to assess the integrity and ethical values of your client before you accept them. Then audit firm's ability to perform engagement. So this is acceptance procedure. So do you have knowledge, training, and experience? What is KTE? Knowledge, training, and experience. So do you have this knowledge, training, and experience before you actually accept a client? So if that client is from hospitality industry, do you have the training and knowledge of audit of hospitality industry? Then will you be able to comply with your ethics while auditing that client? So maybe if you audit that client, he's going to intimidate you, or there will be a self-review, or there will be a self-interest. So are all the ethical requirements met before you accept the client? You should always keep that in mind as a firm. So what are the four things that we have learned from quality management? ISQM 1, it's very important. I highly predict this direct theory question coming up in the paper. I should have a risk assessment process in my own firm as audit firm. so that I have, a good amount of resources available at all times and quality audit being conducted. The top of the tone, like, the governance and the leadership, they should have more focus towards ethics and good quality rather than profit maximization. Then ethical requirements should be met at all times. That means we should train our employees to follow ethics so that they can dodge the self-interest threats and the self-review threats. We should even check whether our component auditors, they follow ethics. And ethics, we should keep note of it. They are not just IASB, they are also many other code of ethics based upon local jurisdiction. Then, fourthly, we are supposed to accept such clients only who are having integrity. And we should, perform audit on those clients only for whom we have knowledge, training, and experience. Correct? Next comes engagement performance. So now, once you guys have accepted a client, now you're going to perform a good quality audit. So to ensure a good quality audit, you should make sure that the direction, that is planning of the audit, the supervision, consultation means getting an expert opinion, audit expert, review and resolution of disputes. That means, what is resolution of dispute? You say there is a misstatement. Client says, no, dear, there is no misstatement. So that is a dispute, right? So how do you resolve that dispute? This whole process of audit, from planning till the review and reporting part, is known as full process of audit. And in this case, I need to maintain my quality. For example, if a case study says that there was a high risk company, but materiality was kept at a high level, that means materiality was maximized even though the risk of the business was very high. You'll say bad quality audit, because if a company is risky company, I need to keep my threshold of materiality at the lowest level possible so that I can identify as many misstatements as possible. Then no review by the audit engagement partner. Most of the times you'll see that, the audit engagement partner was going on a party or he was going on a vacation, and then he said, I don't have time to review all the working papers. So he just quickly signed the working papers without reviewing them. What is the work of the engagement partner? Why he's an engagement partner? Why does he draw so much of salary? He's supposed to, first of all, direct all his team members. He's supposed to allocate work to the team members, direct the team members. And when they have collected sufficient and appropriate audit evidence, it's the engagement partner who's supposed to review their work minutely and check the sufficiency and appropriateness of each and every audit evidence. So if he does not do that, that's a bad quality audit. Then audit is done in less time because the client was pressurizing us or you wanted to save your cost. Again, bad quality audit. Correct? So we have to maintain a good engagement performance throughout the process of audit. Let's go on. No test of control done, bad quality. No work performed on opening balances, bad quality. Human resources. Now we should all have good amount of resources at all times. So in a timely manner, we should have our audit team member available. We are talking about our quality as an auditor. So therefore, I'm talking about my team members only, human resources of audit firm only. So employees with required KTE should be employed. So you are the employer of your audit team. So you should, what if I employ an engineer in the audit team? What he would do? What he would do? Nothing, right? So this is something that we would say that employees with required knowledge, training, and experience should have been employed. Then sufficient level of seniority employed for complex areas. Now, if I allocate IFRS 9 audit to a audit junior, then obviously it screw it up. Obviously, he would totally mess it, and that would lead to bad quality of audit. Then independent experts are hired wherever necessary. Now that is also very important. You should not be, I would say, you should not be greedy. And I would say in Hindi we call it as chindi. So you should not be that greedy that you do not hire experts when necessary. And that is how you manage your human resource, so that you have enough people available for the audit at all times in timely manner. They are having good knowledge, training, and experience. You are, employ right people to the senior level positions, and you hire the experts also wherever necessary. Correct? So that is our sixth point. Seventh point is communication and information. What is communication and information? So this includes obtaining, generating, and using information and communicating the information within the firm. For example, communicating policies to personnel, communication of information obtained during an audit within an engagement quality reviewer, or communication between group and component auditors. It also includes external communications such as to TCWG or a regulator. What does that mean? That means when I am communicating with anyone, I should have good records with me. So if I'm communicating this particular concept to you, I have a note in front of me. It's a record, right? So I should keep a record of what I'm communicating. So if I'm communicating ethical policies to my employees, I should keep a manual of it. Maybe I can create a manual which I will hand over to each and every employee who joins my audit firm, and through which that person can actually read and get trained that what are our ethical requirements. Then we can also have some manual or meeting notes. For example, if we had a meeting, so that is a meeting note needs to be kept, and we need to communicate everything wherever necessary to maintain the quality of the audit. So this is time pass. Seventh point is literally time pass. Eighth, monitoring. So at all times, we should have a process of monitoring the effectiveness of the above points that I have listed. So it's like whatever you're doing, whether you're assessing your risk, whether you are actually having ethical requirements or training your employees, you are having good leadership. So all these points needs to be monitored as well. Okay. It's not that I will just put them in place in my audit firm for once and forget them. I'll also keep on monitoring them. It is again a continuous cycle. Monitoring is a continuous cycle. It's not that one off I would maintain it and second time I won't do it. It's a continuous cycle. So what all are the components of quality management? Risk, governance, ethics, acceptance, engagement performance, human resources, communication, plus monitoring. Risk, governance, ethics, acceptance, performance, human resource, communication, monitoring. Eight elements. I don't know, make a poem out of it. Do whatever you want to do. Learn these headings. Once you learn these headings, what I've taught you today, what I've verbally told you, you will be able to, I can sure tell you, you will be able to frame that answer in the exam. So make a poem out of it. It can be asked for a direct question for 8 marks. I don't want you to lose those 8 marks. That's why I've spent so much time on this question. Are we all clear on this? Quality management elements? Yes. Okay. Now just look at a sample question. So this is from your technical article of AAA from ACCA website. So if you just check this out, where's my pen? Yeah. Candidates may be required to evaluate quality management issues in a scenario and are expected to be specific in their description. So you can't be too generic that this is good quality or bad quality. You're supposed to give a little more detailed answer. For example, they've said consider a situation where the audit supervisor was off work for health reasons. So he was not doing any work because he is having health issues. Yes, I'll share this document with you and the recording is available. So he's having some health issues and the supervisor was off work. And the audit engagement manager was too busy to help out the team perform field work. So as a increment of properties which were identified as high risk. So something which is high risk you've given to your audit junior, what does that suggest? That typically suggests that you were not having enough resources available from your ISQM one. You were not having enough resources available. So weaker response will say not enough resources available, bad quality audit, right? So weaker response. Okay. Is my voice breaking? Hello, mic check. Okay, now. Okay, great. So weaker response would say no, enough, available. This is bad quality audit. But what would my actual response should be? An audit junior has performed the audit of property which contain a high level of judgment when assessing the management's estimate. So basically, we are trying to say that in this particular case of impairment of properties, that particular impairment part is very much, you can say, involving judgment. So it's a very relative or a subjective topic, as this is an area identified as high risk in planning and is subjective. The junior may not have the technical knowledge to audit this area and may have felt unable to challenge the management sufficiently when auditing this area. So in the absence of audit supervisor or more senior staff, the junior will not have been able to consult on difficulties whilst following audit program. There has been a lack of supervision, which could mean any problems have not been picked up on a timely manner. Overall, these factors will increase the risk that sufficient or inappropriate evidence has been obtained. So what are we trying to do here? We are trying to give a more, you can say, exhaustive discussion, not just simply stating it's a bad quality audit, but also stating that, okay, there was a junior who did work on impairment of properties. Now you have to state why cannot a junior work on impairment of properties? Because impairment of properties is a risky area. It involves judgment. It's a subjective topic. And junior, he does not have enough knowledge. Now, that is how you reflect your analysis skill. That is part of your professional marks. So, you will say that the junior is having that kind of lack of knowledge, and this area is very significant. So, if he works on this, he might not have been able to do the best quality of the procedures. And if he wouldn't have done best quality procedures, then automatically, if the management would have tried to intimidate him, he would have got intimidated as well, since he's a junior. So, what we are supposed to do is we're supposed to say if the junior has collected the evidence, the risk is that that evidence is not sufficient and appropriate. So that is why this is a bad quality audit. So this is how you answer your quality management problem in the case study. Okay. So that is something that you guys must read. Okay. Let's move on. And now let's talk about further direct questions like auditor's responsibility for no-clar and fraud. So before I begin with it, I quickly want a confirmation from you. Are you guys clear on our first three questions or not? Are we guys clear? Come on, quickly have a glass of water. I would also have it. After 30 minutes, we guys lose concentration. So get back your concentration. Awesome. Okay. Let's begin. What are the auditor's responsibility with regards to no-clar? Non-compliance with laws and regulation is what I mean by no-clar. So is auditor responsible for the client's non-compliance for laws and regulations? That's the question. So first of all, we all should know that management has the primary responsibility, for compliance with laws and regulations. Okay. So it's the management who is responsible for all the things. First of all, it's management. Okay. So primary responsibility is of management. So if the client is doing some kind of non-compliance, let's suppose the client is supposed to follow some kind of safety regulations or some kind of health regulations, and the client is not following it. So who will be, you can say, prosecuted for it legally? It is the client who will be prosecuted, not the auditor. Yes. Blast Gaming is asking about the handout. See, I'm typing it. So this handout is available after the session in the description box itself. So I cannot give you the handout as of now because I've just written the questions. We are going to type it out as and when we go through the session. Okay. So management is responsible primarily for this particular NOCLA, and then auditor also has some kind of responsibility. So what is auditor's responsibility? His responsibility is only with regards to compliance of laws and regulations whose who compliance of laws and regulations which affect the financial statement. So as an auditor, I'm just concerned about the financial statement of the client, whether they are true and fair or not. I give a damn about their compliance. I just want to see that if this person has not complied with laws and regulations, will it impact the financial statements? Maybe it will lead to fines, penalties. So in that regard, yes. When I am collecting evidence, when I am performing procedures, or when I'm applying my professional skepticism, I have to actually keep care and take care of such laws and regulations which directly impact the financial state. Correct? And also, auditors' responsibility are included in ISA 315. Because if you remember from ISA 315, we are supposed to understand, we are supposed to understand the pestle of the client, isn't it? We are supposed to understand the political factors of the client, the economic factors, the social factors, the technological factors, the economic factors, and the legal factors. So, in that situation, I am supposed to check all these laws and regulations when I'm understanding the client. So, while understanding the client, I need to understand their laws and regulations as well. As an auditor, that's my responsibility. Now, if there is any NOCLAR which the auditor has identified, if any NOCLAR, let's paraphrase it. If a NOCLAR is identified or suspected, then the client, the auditor is supposed to gather evidence regarding the nature and circumstances of the event and how does it impact the financial statement. So this is what we are supposed to do as an auditor. So if we have identified or suspected any NOCLAR, we are supposed to further work on this. We are not supposed to leave it. We are supposed to work on this. And yes, we are supposed to find that what was the nature and circumstances of that NOCLAR? Why did that happen? And how does it impact my financial statement? So that is the keyword in our answer. Then going forward, what should we do? If we have identified any NOCLAR non-compliance, how we should, try and tell it to the those charged with governance, to whom to report NOCLAR. So if auditor has identified any NOCLAR, whom to report? First, you would report it to the those charged with governance, correct? Okay. You might disclose it. You might disclose it to third party. So, for example, if something is in the public interest, if it is in public interest that you must disclose this non-compliance of laws and regulations, you must disclose it to third party. For example, if there was child labor, now child labor is a crime, right? And if you see this happening, that is non-compliance with laws and regulations. So now you won't wait for those charged with governance to come and justify why they're doing this non-compliance. You'll immediately report this to the police. So you'll report it to the third party because it is in the public interest that you actually report this NOCLAR for the good of the public, for the good of the children, right? So you need to disclose it. Then what else should I do? To whom should I report this? Okay. So if I can even take some legal advice. So if I'm not sure of this, I can even try taking a legal advice that there's a NOCLAR in this particular situation. I don't know if I should inform it to TCWG or to disclose it to third party. So on that, you can get you can say you can get a legal advice. Now the question comes that, okay, if there was a NOCLAR, what is the auditor's liability? There are two types of NOCLAR. One which directly impacts the financial statement. So I told you directly impacting what laws and regulations would directly impact the, you can say, financial statements. Anything which is related to debt convenience directly impacts your financial statements. Then you can say there are many such things, case to case, they would vary, which directly impact the financial statement. In that case, as an auditor, I'm supposed to collect sufficient and appropriate audit evidence regarding the compliance and the cases in which I do not have, or the law and regulation indirectly impact the financial statement. That means if that law and regulation will be breached, then there will be a fine and penalty, and then that fine and penalty will be recorded in financial statement. In that case, I would say it's an indirectly impacting laws and regulation. So in that case, I have to just, maintain my professional skepticism, and I need to keep my inquiries on. So here I'll just keep my inquiries ongoing with the management, that, or, I can check their correspondence. So this is what you can do to keep a check on whether there is any non-compliance. So there are some indicators also of non-compliance. So if you see a lot of commissions being paid, why would you pay commissions? Under the table commissions. So maybe there are some situations where you have breached a law and now you're trying to get out of it, you're trying to dodge the bullet. So in that case, you pay commissions, no? So that is an indicator that you're paying so many commissions. Maybe you've done some NOCLAR, non-compliance. Then there are some indicators like, for example, a lot of cash is going out. So that means maybe you're trying to bribe someone, or there is a lot of notices that are being received, legal correspondence which is being received, or you can say someone who's a key personnel has been replaced. So maybe that person has been replaced because he did a blunder or he did a NOCLAR. That is the reason we replaced him. So these are some of the indicators in the case study which you can always figure out for your non-compliance with laws and regulations. Right? So this is something that we need to do from our laws and regulations. So I hope we all are clear that what are the responsibilities of the auditor with regards to laws and regulation. These are the responsibilities. So primary responsibilities of the management, secondaries of the auditor. He's just supposed to see whether you're complying or not. How does he see that? In understanding the client, he reviews the regulations. Secondly, if he identifies or suspects any NOCLAR, then he's supposed to collect evidences about the nature and the circumstance and its impact on the financial statement. And if he reports a NOCLAR, to whom he should report? First to TCWG. If he thinks TCWG is involved and is trying to hide this fact, he might disclose it to third party, and he can also get a legal advice with regards to this situation. So are we all clear on this, NOCLAR? Yes. Let's move on to fraud. This is what we should know from non-compliance with laws and regulations. Now come to fraud. What are the types of fraud that we have? The first type of fraud that we have is fraudulent reporting. Fraudulent reporting, where basically we try to pass wrong journal entries, incorrect journal entries. We try to add ghost employees. Come on, that is something which is fraudulent reporting. So that is one kind of fraud that you do. That is basically earnings management, or you can say that is window dressing. Yes. Then second type of fraud is misappropriation of assets. So misappropriation of assets. What is misappropriation of assets? When you use assets of the client or the business for own use. So the client is using their own assets of the business, or treating their you can say taking the car of the business to their house using it for personal purpose. That is all like theft of cash by the person who's handling cash. That is misappropriation of asset. Misusing the property, plant, and equipment. That is again misappropriation of asset. So these are the kind of frauds which can happen in a company. Now, once again, what is the auditor's responsibility with regards to fraud? First of all, auditor is not responsible for fraud. So yesterday, I think we were doing a question on this with my students in Super 20. So the question said that there was a fraud and the client was trying to sue the auditor because there was a fraud. So there I talked about professional liability. I talked about negligence. So who is actually responsible for the fraud? Management. Management has the primary responsibility. Management has primary responsibility for prevention and detection of fraud. Then why is auditor coming into the picture? What should auditor do with regards to the fraud? Same as laws and regulation. Auditor, see, auditor in all good circumstances might not be able to detect the fraud even if the auditor works to his best possible, works to his best possible quality, because nature of fraud is that the preparator of fraud wants to conceal it. Also, the evidence that auditor might gather is persuasive in nature and not conclusive. What do I mean by this? Persuasive in nature and not conclusive. See, if you see something bad happening in your client's firm, right? So, yeah, if you see anything bad happening in your client's firm and you get evidence for it, that just suggests something. That does not give you the direct indicator or 100% kind of a guarantee that there was a fraud. Come on, start uh, scolding your client or start your you can say investigations. It's persuasive in nature, it's not conclusive. There would be investigation done on that. So it's not possible for the client or the auditor, I won't say client, but the auditor, to detect the fraud so easily. And also, auditor auditor does not perform procedures on 100% of the areas, as substantive procedures are performed are performed on material heads. That too, many times sampling is used. Sampling method is used, which suggests that many events suggesting or indicating fraud might go unnoticed by the auditor. So that means auditor does not has a direct responsibility that he should be preventing or detecting the fraud. But what he can do is he can actually talk about the internal control weaknesses of the client, which suggests that there might be fraud. So in that way, he would be able to prevent fraud. So what I can say is, what auditor can do is, all that auditor can do to detect fraud is to be professionally skeptical, to maintain professional skepticism, right, at all times, and to keep the inquiries with the management going on regarding any contradictory evidence, regarding any contradictory evidence or or unusual transaction. Also, if management is involved in fraud, it further becomes difficult for the auditor for the auditor to detect fraud. Because when you talk about procedures, most of the times you say discuss with the management, inquire from the management. So the people that we are trusting, that is the management, if they themselves are involved into fraud, how difficult it is for you to actually identify fraud. So this is what we can state with regards to fraud, that okay, these are the 6 things that you should memorize, that auditor cannot at all times be responsible for this. So what he is responsible for, let me write that last line, what he's responsible for. Auditor, however, is responsible to detect or to identify the risk of material misstatement due to fraud. So if auditor has lacked his duty of care to perform substantive procedures on a risky area, on a risky area or material area, then yes, up to some extent, up to some extent, auditor is responsible for the fraud. So you will see this question. I don't know if you guys have attended the Super 20 or not. There was one of such question where they said that the payroll of the client was not audited correctly, and there was a fraud in the payroll due to which the client has to suffer financial loss. So the client is planning to sue the auditor. I hope you remember that. So in that case, we wrote that yes, the duty of care existed, and that was the reason why the auditor had a liability for this fraud. Correct? So are we all clear on this? Come on, quick confirmation. We all clear on this? Okay. Now professional liability. Come on. So I think one of my student Divyanshi was asking this regarding professional liability. So all that you guys need to know from professional liability, that is important from your exam perspective. Okay. Let's talk about that. Professional liability. I should know the civil liability case. Okay. When there is duty of care. So when do you have liability that is civil liability? See, you have criminal liability also as an auditor when you sign an audit report or when you enter into a contract. You might have a civil liability or a criminal liability. That basically is, you can say it is basically treated as a civil or a criminal liability based on the contract that you've signed up. So if you sign a contract with some of your supplier that, if I do this with you, if I breach your data, then you can sue me criminally. So that is kind of a criminal liability. But if you say someone has not paid you, that is civil liability, or someone has hampered the quality, that is civil liability. We can't say it's a crime, right? So that depends upon, I would say, it depends upon the question to question. So civil liability, let's say, what is the case of civil liability here? I would say three things should exist. Three things should exist if someone wants wants to sue the auditor, because we are doing audit, right? So I'll do it from the auditor perspective only. It can be against anyone. First of all, duty of care must exist. Duty of care must exist. Then there should be a breach of duty of care. Breach of duty of care. And then there must be a financial loss to the client or to the counterparty, which can be quantified due to this fraud or due to this whatever happened. So, what is duty of care? There is an automatic duty of care between the audit firm and the audit client. So, there is an automatic duty of care. Okay. Yeah. So, there is an automatic duty of care automatically exists between client and audit firm. How? Because when you guys get employed as auditor of a client, you're supposed to give that kind of duty of care in your work that you're doing. So you are supposed to be diligent towards the work that you're doing. Your report is going to be issued in the public. So you have a duty of care. So if I'm talking here on this platform, public platform, I know sometimes there are, I would say, slip of tongue, but still I have a duty of care that I should be giving out true and right facts to you on this platform. That's the duty of care. So duty of care must exist, and it automatically exists between the client and the firm. Now imagine a situation where I'm the auditor of company A, and this company A's audit report was used by Mr. Ram. Now Mr. Ram was one of the investors, like he was having one share in that company. Now can Mr. Ram sue me if he invested in one share because of the report that I signed? Now that depends upon the particular case study. If in the audit report, the auditor mentions that this report is addressed to shareholders and potential investors, right? So there, the duty of care exists. So it is basically dependent upon to whom that audit report is addressed. If the bank gave the loan to the client because of the audit report which was signed by me and it turned out to be wrong, can bank sue me? If I have mentioned a paragraph in my audit report that this audit report is only to be used by shareholders, existing shareholders of the company, not potential shareholders, not the employees, not the tax authorities, not the bank, then who's at fault? Is the auditor at fault or the person who's using the report at fault? Person who's using the report is at fault. So I should make sure that duty of care must exist. And between the client and the audit firm, duty of care exists. Now there must be a breach of duty of care. Now, for example, you were supposed to do good quality audit, but you breached it. For example, bad quality audit was done. Bad quality audit was done. Now that is breach of duty of care. Any fraud was done. Fraud was concealed purposely. Purposely. Again, that is breach of duty of care. So maybe you got friends with the director of that company and you colluded with that person and you committed a fraud as an auditor. So that is something which is breach of duty of care. Now, has it caused a financial loss to the business, to the client that needs, or to that person who's suing you? That needs to be determined and that has to be quantified. So if there is a financial loss existing which can be quantified, then yes, in that particular case, of course, there is a breach of duty of care. This is known as negligence. And for the sake of negligence, you guys can actually be also, not you guys, but the auditor can also be sued. right? So the auditor can also be sued for this. Come on, tell me, do you understand this liability case? Do we understand this liability? Yes or no? Come on, quick confirmation. Okay, that's great. Now, guys, we'll talk about how can I actually limit the liability. How can we actually limit the liability of the auditor? How is it possible? Can you give me some suggestions how the liability of the auditor can actually be limited? Do you have any points in mind? Okay. Better quality control, limited liability partnership, engagement letter. Good. So come on, let me discuss this concept with you as well, that how can I actually limit the liability of the auditor? So auditor is now liable, and that is the reason why most of the people do not appreciate getting into the audit field or becoming an audit engagement partner. Because whenever we sign an audit report, we have a lot of liability attached to it. Now, how can we limit the auditor's liability? That becomes a very big question. So first is that when you accept your client, you should accept such a client who is not so risky. So prevention is better than cure, right? So if you know that a business is having a lot of stuff involved in it, the client is having a lot of stuff which is risky, due to which you might end up in a problem in future, so don't accept such a client, right? For example, he's involved in money laundering. For example, he's having a lot of risk of compliance, a lot of safety regulations are applicable on it, or that business in itself has a bad reputation. So that is something we can say, that prevention is better than cure. Don't accept such clients who are risky companies, from the perspective of that there can be an issue in the future. A. Second thing I can talk about is keep documentation ready. So if you know that there is a liability attached to what you are signing, so tomorrow anybody can come up and say, I used your audit report, you signed the audit report of this particular XYZ company, now I'll sue you. And you don't have enough documents with you. How bad position you all will be when that court case happens. So they say that keep your records for a longer period of time, so that you are able to, manage that liability situation also. You're able to manage that court situation also. So first is don't accept risky clients. First, if you have accepted them, then keep the records for a longer period of time, proper documentation. Then thirdly, quality control. So very rightly said by Divisha on the chat box, maintain high quality audit. That means if you will not do, I would say, if you don't screw your quality of audit, and if you keep it good, then why would anyone sue you? So if you are good in your work, nobody would sue you, right? So maintain high quality audit. That is one situation where it's like you can be limiting your liability. Then another is that you issue disclaimer in the audit report. What is disclaimer? So have you seen, before we start some of the TV series, especially in India, or when we start movie, they give a disclaimer. For example, recently there was some kind of movie being made which was related to traditions of India. Okay, it was related to religion. So some people said this is incorrect. This is not basically as per the right historical evidence. So everyone works on evidence. So in the world of entertainment, also they look for evidences. So anyway, it was history. So they said there's no evidence of this history that you have portrayed in this picture or movie. So what the producer was asked to do is provide a disclaimer that this has nothing to do with reality. This is a fictitious, or this is a friction, or you can say it's not real, whatever is depicted in this movie. So that is a disclaimer that we give. Right. So in the audit report also, you can give this disclaimer that this audit report is to be viewed by just the shareholders, or maybe just the client, or maybe just the bank, for whomsoever you're preparing this audit report. And it is not to be read by any other person, or we are not liable for any other person. So that is something where you are being like, I don't own this responsibility. So give that disclaimer in your engagement letter also, and your audit report also. Then keep your engagement letter with you. So in engagement letter, your auditor's responsibilities are fixed. So negotiate with the client. Engagement letter is like you sign a contract with the client. So you need to negotiate with the client that these are my responsibilities and these are not my responsibilities. I'll just do these things. These are not my things to do. So this is a proof that I am just responsible for these many things and not these things. So engagement letter is also something which can help you to save your skin in a future time. Then capping the liability. When I say capping the liability, God forbids, sometime in future you are sued and it ends up with the conclusion that you were at fault. Now you have to bear the cost of it. Now in the initial stages only, don't be like too much optimistic and be like, no, nothing bad will happen to me. Anything can happen at all times being a professional. So you need to cap your liability. That means in the engagement letter itself, in the audit report itself, you'll mention that I will only pay or I will only compensate for any kind of thing happening uh, up to just this extent, that I will cap my financial loss to this extent. Now, that financial loss can be as a proportion of client's turnover, or it can be as a multiple of your audit fees. So, proportion of client's turnover or multiple of your audit fee. This is how you cap it. Lastly, you can also create a limited liability partnership. That means you can incorporate your firm. So, if you incorporate your firm and you don't act as a sole proprietor, so I am a sole proprietor, so I am liable for TG professionals. Like if there is any liquidity in future, I hope it's not. So if there's any liquidity in TG professionals in future, I will have to sell off my house and my stuff to pay off those funds because I'm the sole proprietor. But if I talk about if I got it registered, but I'm planning to do so, so if you get your business registered, you become like independent. You are the founder, you are the CEO maybe, but you are not actually you have a separate legal entity basically. So in sole proprietorship, you don't have a separate legal entity. Both of you are same. And whereas in limited liability partnership, there is a separate legal entity. In companies also, there's a separate legal entity. So if there is something to be done, is to the company, not the person. So company will be sued, company will have to pay some fees, not the auditor himself. And also, you can also get some professional indemnity insurance. So, what are the things that you can use to limit auditor's liability? I can accept clients which are not risky. That is, prevention is better than cure. And then I can also go on and, I should be doing good quality audit. Then I should have proper documentation with me. Fourthly, I should give disclaimer of like my liability. I should use engagement letters. Maybe I cap my financial loss threshold. Then maybe I have an insurance that in future, if I'm sued, I will have some insurance with me. I can incorporate my firm and I can create a limited liability partnership. So I've given you so many points. Let's quickly write them out. I hope we all are clear on these. So I'll just quickly write these points, keywords. First is accept acceptance procedures, like accept less risky clients. Prevention is better than cure. Prevention is better than cure. Then second is your documentation must be maintained. enhance your documentation for future investigation. Then, thirdly, you can disclaimer of liability in the audit report. Yes, you can also cap the financial loss that you would bear, which can be as a proportion of client's revenue, proportion of client's revenue, or it can be as a multiple of audit fees. Correct? Then what else can we do? Limited liability partnership can be incorporated. Use of engagement letter. Lastly, good quality audit, quality maintenance, quality audit. So all these things, if you actually, if you actually apply this, you'll be able to limit the liability. So I hope we all are clear on this. Come on, yes. Let us take a small little break of 5 to 7 minutes, and then we will start with principle of ethics. So taking a small break of 5 to 7 minutes, and then we resume with our session. So don't ask me, ma'am, I can't hear you, I can't see you, because we are on 5 to 7 minutes of break. Okay? Have some food, walk around, don't log out, okay? Come back and make sure you listen to it, because if you keep it as a backlog, then you end up creating and piling up a lot of backlog. So see you all in 5 to 7 minutes. Hi all. So I think we all are back from the break. Can I get a quick confirmation? Audible, visible? Yeah. Okay. Now let's talk about principle of ethics. Yes. Let's talk about principles of ethics which we have in our advanced audit. So what are principle of ethics we have to follow as per the code of ethics? So we have PICOP. Yes. PICOP, where P stands for professional behavior. Yes, P stands for professional behavior. Then I stands for integrity. I stands for integrity. C stands for confidentiality. So you all should know the meaning of these terms as well. So I'll give you the keyword for all these words. Then O stands for objectivity. Objectivity. P stands for professional competence and due care. So, what do I mean by professional behavior? Professional behavior means not bringing discredit to your or disrepute, not bringing disrepute to the profession, to the profession. Now, that is being having a good professional behavior, right? So, not bringing disrepute to the profession is being professional, or you can say not, for example, if you use bad language, foul language in your professional, I'm not saying foul language with your friends, that's a different story, but maybe with your client. So that is something which is unprofessional, that brings dispute to the profession. So in that case, you would say this is not professional behavior. Then if I talk about integrity, integrity is being straightforward and honest. Straightforward and honest. So in your approach, you should be very much straightforward and honest. That's how you ensure that you are truthful. You are having integrity. What is confidentiality? Confidentiality is that we should confide or we should not leak the sensitive information or any information that we've received as part of our business relationship without prior permission. So, without prior permission, I should not leak out any information that I have gathered. But I can give out this information in few cases. Confidentiality can be breached. Only confidentiality can be breached if it is required by public interest. So it is in public interest to do so, okay? Or it is required by law. So you can only do this breach of confidentiality, either it is in public interest or it is required by law to do so. Otherwise, you're not supposed to leak out the information. So, for example, there is a conflict of interest. Let's talk about a situation in ethics of AAA. I'm sure you must have heard about this conflict of interest. So, for example, if I have, for example, uh, the audit client, the audit client's competitor is also our client. So audit client's competitor is also our client. So in that case, we would say there's a conflict of interest. So what we need to do is we need to sign confidentiality agreements. We need to sign confidentiality agreements with both the parties. First of all, we need to inform both of them that, for example, you are working with KPMG also and you're working with Deloitte also. Maybe you are a tech service company, IT company, and you're working with KPMG and Deloitte both. And they both are competitors. So what you will do is you will inform both of them that I'm already working with one of your competitors, and you will get confidentiality agreement signed with both of them. You'll get their acceptance that they're okay if you're working with their competitor. They have no problems in that. Otherwise, if they don't agree, then you will not accept the latest client. So if I was already working with KPMG, Deloitte is my latest client, so I'll not accept Deloitte unless I sign confidentiality agreements with KPMG and Deloitte both. Right? So that is application of confidentiality. Then I talk about objectivity. Objectivity is being fair. Being fair. That means not biased. So if you're not biased, you're objective, correct? So if you are objective, for example, as from auditor perspective, you have to, for example, you are doing fraud investigation. So in fraud investigation, your first ethical thing is that you should be unbiased. Now, just because you dislike somebody, you would not purposely put the blame of fraud on that person. You're an investigator, you have a duty of care, and you have to maintain that. So you are being objective in that. As an auditor, if you're trying to figure out who is the perpetrator of fraud, as an auditor, if you're trying to figure out that you know who made the error or what control weakness led to the error, so you need to be objective in that case. And you are supposed to think not just about the client, but the client shareholders also, their investors also, their you can say the company which you know maybe has provided debt to the client, so the bank also, the tax authorities also. So you have to think about all the stakeholders and not just the shareholders, right? So that is objectivity. What is professional competence and due care? It is application of knowledge, training, and experience of the auditor. So the auditor at all times should be competent. For example, if he's an ACCA member, he should get his CPD done, continued professional development. If in a case study, the audit firm says to save our resources, we will not do the CPD. Bad quality. Because if they don't do the CPD, their professional competence will be hampered. How will the auditor have the knowledge of all the IFRSs and the ISAs? Why do I say audit and SBR are so interlinked? Why I love teaching SBR and audit together? Because IFRSs and ISAs are interlinked. So you should have continued professional development. You should have that, you can say, knowledge, training, and experience of IFRSs and ISAs both. Any recent developments in both of them, you should be aware of it, right? So that is what we mean by professional competence. These are the principle of ethics. Now, there are some cases where there are threats to ethics. This is the very regular kind of a question that we get in the exam, right? So here we talk about the ethical issues. So in the case study, they ask you, write about the ethical issues. So what is your strategy to answer? First of all, what you need to figure out is, in from the case study, that which threat is being faced. Which threat is being faced in that particular situation? Which ethical threat is being faced? Self-interest, self-review, advocacy, management threat, intimidation threat, familiarity threat. You are supposed to identify and name that threat. Then you have to tell why is it a threat. So basically, you have to describe that threat, that why is it a threat. So if I say in a situation, for example, let's take a situation of overdue fees. Come on. So if as an auditor, your fees is still due with the client, you will consider it as a loan. It is considered as a loan to the client. So if you have given loan to someone, first of all, you have self-interest. What is your self-interest? Because you want to recover your loan. Another thing that you have is intimidation. Why intimidation? Because now they would say that our, your money is pending with us. So we are yet to pay you. So you do what we say, otherwise we will not pay you. So that is a kind of a perceived pressure, not an actual pressure, but a perceived pressure, intimidation. So overdue fees is considered as a loan to the client, which gives rise to self-interest and intimidation threat. So you will explain it here that why it gives rise to self-interest. So you will say it gives rise to self-interest threat as the financial recovery of the fees or the recovery of the fees and the recovery of the fees is the financial interest of the auditor, and he would want to maximize the revenue. And what is the significance? Second, like you told them what is the threat or why is it a threat. Third is, what is the significance of the threat? Significance depends upon the size of the client. It depends upon the person position. So if the threat is related to someone who's the audit engagement partner, the significance of the threat multiplies. If it is related to finance director of the client, the significance of the threat multiplies. So you talk about its significance, whether the company is listed or unlisted. That also determines what is the significance of the threat. So here I would say, for example, this company was listed. It gives rise to self-interest threat. The significance of the threat increases due to the fact that audit client is listed. Yes. So this also gives you 1 mark. So you're getting your points for identifying the threat. Why is it a threat? And what is the significance of the threat? And lastly, you tell them what are the safeguards. So see, if it is a listed company and there is a management threat, there is no safeguard. But if there is any other threat which you think can reduce the ethical threat to an acceptably lower level, then you need to provide safeguards. Most general safeguards are quality control review being conducted on that particular thing, or separate team being used, separate team is used. Yes. So these are the most frequent, I would say, safeguards which are used. So these are the strategies to answer ethical issues. Now, what kind of threats do we have in our AAA syllabus? What kind of threats do we have? First threat is self-interest. You all know what is self-interest? When your financial interest is vested in the client. For example, if you have invested in the client, that you have shares in that client, you immediately need to dispose those shares before you move ahead with the audit of the client. Then we have, for example, gifts. Gifts is also a self-interest. I would like to please my client so that I receive those gifts more often. Maybe they're giving me luxury gifts. Maybe they are giving me a vacation to Dubai. That is a luxury thing. So that is a self-interest which is vested, right? Then what I have is I have self-review threat. What is self-review threat? Checking your own work. So if you check your own work, what happens? Checking your own work. If you check your own work, you do not find your own mistakes. You are hesitant to find your own mistakes. That is the why I say that all of you should and must get one mock checked by some expert, because if you check it yourself, you'll have self-review, at least one. Others you can do yourself, but at least one, get it checked from someone. Okay, so self-review threat is there. Then I have familiarity threat. What is familiarity threat? Familiarity threat is basically like if you are too much familiar to someone, like friends with someone, it's a long association or very personal, close relationship with the client, which will make you favor the client. The keyword is being favor or favoring the client too much, bending to the needs of the client because you know the client. That is familiarity threat. Then you have intimidation threat. Come on, what is intimidation threat? Intimidation threat is when there is an actual pressure or perceived pressure due to which you compromise your objectivity. That means you feel pressurized, threatened. For example, the auditor is told by the client that complete the audit in 2 months. Pressure. Yes, if the auditor is told that we will just pay you this much or reduce the fee from the previous year, slash the fee from the previous year. Pressure, intimidation. So you have to be like a very, I would say, how do I say this? You have to be very, like anything that happens, you have to react to it. That if the client is trying to limit the scope of the audit, you need to react. If the client is trying to threaten you, need to react. You say, no, this is intimidation. I don't accept it. So if the client tries to be bossy, you need to say, no, this is not allowed with me. So you have that kind of attitude as an auditor, right? Then what we have is um, after intimidation, we have management threat. What is management threat? When you get into the shoes into the when you get into the shoes of the management. So getting into the shoes of the management. So you try to see yourself as the person who's making the decisions of the company. For example, if there's a small company and that small company hires you as the only professional. So you are the only professional who's doing everything, like preparation of financial statements, audit of financial statements. So at the end of the day, they might over rely on you because they're small firm, right? So they don't have enough information or enough knowledge. So they would make you the main decision maker. So that is management threat. Another management threat example would be if I develop the IT system, if I develop the controls related to financial reporting. So I might get into the shoes of the management. So I am not management, I'm the auditor, I'm the checker. So if I check your mock, I'm checking the mock. I'm not supposed to actually write your mock, right? So management threat is when you think that writing the mock is also your responsibility. Then lastly, we have advocacy threat. What is advocacy threat? When you the interest of promote the interest of the client way too much. So that means you're trying to promote, for example, you go to in with the client to a bank meeting where the client is trying to take a loan and you sign an audit report and you say that this client is really good, he's doing good with his finances. That is advocacy threat. And this also carries a legal responsibility. Yes. So a legal responsibility arises because if you say that this client is good, I am the guarantor of solvency of this client. So you're trying to take I would say you're trying to take the sword in your back only yourself because you're trying to be like responsible for their finances. So what if this company actually liquidates and they don't have enough funds with them? Who the bank is going to contact? Who is the bank going to contact? They're going to contact you only, right? So this is a legal responsibility. So I hope we all are clear on the threats that we have. Let's check out some specific situations. What we have is gifts. So what is the rule attached with gifts? Whether listed client or unlisted client. Whether listed client or unlisted client, I am supposed to see the nature, value, and intent of the gift. If I conclude that this is trivial, then only it is accepted. Otherwise, politely decline. If your audit junior accepts such gift, give him a slap and tell him, train him that you're not supposed to accept such gifts. So this leads to self-interest threat, right? That is the reason we decline. We decline the gift. Then compensated on the basis of non-assurance services. So sometimes the client says we'll pay you on the basis of how you perform as non-audit services. So is this allowed? So this is once again leading to self-interest threat. Why? Because then the auditor will have the threat or the motivation to actually enhance the non-insurance services revenue. So he would have that self-interest threat. And this is again in listed companies or unlisted companies, this is like not accepted. So this is a self-interest threat. We can just say that. And see, what will be the safeguard? We can't say that if someone is actually compensated on the base of non-assurance services, the safeguard would be that we should remove that person from the team, remove the person who is uh, getting this from the team. NAS is non-assurance services. So remove that person from the team or conduct quality control review on his work. So whatever work he has done till date, after removing him, please do some QCR on it. Then fee dependence. What is the rule attached to fee dependence? They say if for two consecutive years, the fees from one client is 15% or more of total revenue, then we consider this as over dependence or fee dependence on that client. Now, this also gives rise to self interest and intimidation. So, if you say you have just one biggest customer, you have one big customer, and if that customer leaves you, you'll be totally shattered. So in that case, you say this is self-interest threat. I would try to retain this customer as long as possible. And also there will be an intimidation threat because I'll always try to bend to the needs of my customer so that, he does not leave our audit firm. So what is the safeguard for this? What safeguard can you apply? Come on, give me the safeguard for this. What is the safeguard for fee dependence? What is the safeguard? Depends upon whether the company is listed or unlisted. So what is the safeguard for listed companies? Safeguard for listed companies? Yes. Safeguards for listed companies. Top two, TCWG, reduce fee dependence. Quality control review. So reduce the fee dependence. Stop providing non-assurance services if that reduces the fee dependence, right? So you are supposed to exercise these safeguards. Discuss with TCWG. Yeah. So this is what you do for fee dependence. Overdue fees I've already written. Contingent fees. Come on. Contingent fees means it's dependent upon certain criteria. So can I accept contingent fees? It's prohibited. You cannot accept contingent fees because this clearly gives rise to self-interest threat. Correct? So it is not to be accepted. Contingent fees gives rise to self-interest threat. So it is not accepted at all. Contingent fees means that it is based upon some kind of outcome that, if our revenue would be this much, then we'll pay you this. No, fees is dependent on the scope of work. Audit fees is always dependent on scope of work. So this is not to be accepted. Now, non-assurance services. Some services are accepted with safeguards, others are not. So in listed clients, I'm just talking about listed client, okay? So in listed clients, if any service relates to financial statement, for example, preparation of financial statement, right? For example, valuation services where the value will be added in the financial statement. Or, for example, any kind of service which is related to IT systems which work on the financial statements. Or internal control, which is also related to financial reporting, that is financial statement. So all the services which are related to financial statements are strictly prohibited. Correct? So anything which is related to financial statements in listed clients are prohibited. I'm talking about listed clients. So what are the services which are allowed in that case? Services like where we give advice, advisory services, services where we, for example, just file the tax returns. That is clerical work. You are not actually calculating the tax. Computation of tax is not allowed, but tax return can be provided. So where you advise, where you file clerical returns, all these things might be allowed. So are you getting the logic behind it? Anything where you are related to financial statement, calculation part, reporting part, presentation part, that is prohibited. Otherwise, if it is an advisory thing, if it is unimportant thing, it is allowed. Then if I talk about unlisted companies, in unlisted companies, every non-assurance service is allowed with safeguards. So I can provide all non-assurance services in unlisted clients with safeguards. Safeguards can be separate team, always separate team is used, and QCR is done. Right? So this is what we have for our listed and unlisted clients. So in a question, whenever you find any kind of, for example, they say, give us advice with regards to controls. I can give advice. If they say, design and implement the control, that is management threat. How can I design and implement the control? That is the responsibility of the management. I'm the auditor. So I will not accept it. If they say, design and implement, or you can say even if they ask you to prepare financial statement, that is also not allowed. Valuation not allowed. So all these things where we have anything related to financial statement in listed companies, related to any account balance, account transaction, or disclosure is prohibited. Rest all is allowed with safeguards. So this is also with safeguards, right? Are we all clear on this? So these are some of the situations of ethics that I've considered, which are like mostly used in the Super 20 questions which were done. Apart from them, there are so many others, but you do understand the essence, correct? Yes, advices can be given. Overdue fees, I've discussed this already, no? Overdue fees. So, safeguard for overdue fees. What can be the safeguard for overdue fees? For listed clients, again, first safeguard is that before starting new work, the repayment should be received, or payment plan should be made. So you need to discuss it. You need to discuss it with the management that, okay, uh, we have some overdue fees. You need to first clear your dues, then only we will move ahead. If you don't do it, otherwise we will not do the next work. So you should at least make a payment plan. You should fix it and you should communicate it to TCWG. Right? Okay. See, anything which relates to financial statement, whether it is advice, let me clear it. When I say advice, advice related to financial statement, advice related to, for example, controls on financial statement, for example, management information system, MIS. So that is not allowed under the listed companies. But if it is an advice in general, for example, their advice related to business general, where they should expand, what they should do, that is allowed with safeguards. But when I have to be specific on financial statement, how to record this, how to do that, that is not allowed. In listed clients, anything related to financial statement, even if it is advice, not allowed. Sorted on that? Advice in general related to any other thing apart from financial statement, allowed. Yeah. Okay. Let's move on. So this is all that I wanted to revise from your ethics. Let's talk about money laundering now, a very important yet theoretical topic. What is money laundering? Money laundering is nothing but a process of concealing the true origin of illicit funds by placing it into the legal environment, placing it into the legal environment and layering it with a lot of movement so that finally its true origin is untraceable. See, I can make my own definitions. So in audit, when you say no, I have to use professional words, I have to use just the words in the keywords which are given. Okay, that is fine. I've used all the keywords here, but still I made my own definition, right? So it is basically when I convert black money, black money into white. That is what we call as money laundering, right? So, yeah. This is the process of money laundering. What are the stages involved in money laundering? Steps involved in money laundering? Placement. Placement is there. Placement means you just quietly place the funds. For example, there is something like we are having a cash intensive business. So in a cash intensive business, in the same drawer, I have my revenue from customers in cash, and I put the black money in that, and I mix it well, stir it well, like I make a lemonade. I stir it well, and then I actually integrate into my legal environment. Maybe I buy a property out of it. So that is, yeah. So placement is there where we just place the funds. For example, we mix illegal funds with till receipts. So if it's a cash intensive business, that is where you will have till receipts. Layering is when you move the money a lot. Movement of funds happen to overseas banks from one bank to another. So intra bank and intra nation across the border also. That is layering. Then you have integration. What is integration? Then you finally bring the black money back to the economy. So legal economy. So you bring it back to the legal economy. Like for example, you invest it. So for example, integration would mean that you buy luxury goods out of it. Luxury goods. Like you buy car out of it, you buy property out of it. So that becomes your wealth. So that is like integrated. So placement, layering, and integration. So what are the indicators of money laundering? Indicators of money laundering in any situation, in any case study. I'm just giving you some. For example, there is a cash intensive business. There is an unusual transaction, unusual big transaction. Then maybe there are smurfs, small transfers to various bank accounts, to various bank accounts. So that can be like, yeah, bank accounts. Then there can be some, for example, sudden, yes, foreign subsidiaries or overseas bank account. Then maybe there is some kind of, uh, you have your account in a tax haven. For example, give me some examples of tax haven countries. Cayman Islands, yes. Swiss bank. What else? Cayman Islands is there. Which all countries are there? Ireland, yes. Then Singapore, Panama, Bahamas, true that. Hong Kong, yes. So just memorize these three, four countries. They are tax haven countries. So if you find that there you have a bank account there and you keep on transferring Bahrain, yes, you keep on transferring your money there. So that is also an indicator of, like, we can say money laundering. Now, what is the suggested action or method against money laundering? Yes, method suggested by ACCA against money laundering. First, appoint MLRO. So who in the world is this person? He's a senior member. He's a senior person. So in every firm, this is a senior personnel, senior member to whom you report any, suspicion of money laundering, and he prepares a report which is like it consists of who is the suspect, what is the nature of transaction which led to the suspicion, and what is the amount which is involved, and what all things, etc. They report it to the enforcement agency. So this is what we have for MLRO, things that you should remember. Then second is KYC. So I should always do KYC of my client. So while accepting the client, I should assess whether this client is having, who is the owner of the company, what is the ownership document, if that is a politically exposed person or not. So all these things I should see, the risk profile of the risk profile of the company, like the reputation of the company, I should see, so that I know whether they are having the management having is having integrity or not. All these things are to be sorted before I accept a client. Then I should do enhanced record keeping. So enhanced record keeping. So in case something happens, you should always have the records with you. Then you should also see their source of funding through that Srishti. So from where are they getting their funds? Then what else should I do? Communication and training. So I should train my employees that from the grassroots level to senior level, that how are they supposed to treat a suspicion of money laundering. That means I should tell them that please don't tip off. What is tip off? That if you have any kind of suspicion against someone, you're not supposed to actually go and tell them, dude, I have a suspicion on you. So if you see a thief, you don't go and do a peekaboo to the thief, right? You try and call the police there, and you don't let the thief know about your presence, and you catch him red-handedly. So you are supposed to teach them that don't tip off and how to report. You need to teach them about MLRO, train them. Then what else is there? What else is there after communication and training? Which another point do we have? Come on. KYC, enhanced record keeping, communication and training. Is there any other point? Yes. Internal audit function. What to write about internal audit function? Very good. Policies and procedures. So I should have a proper policies and procedures and internal controls in place. And also I should keep monitoring those policies and procedures. So these are the things that I should have against money laundering. So if you know these things, if you have the confidence to explain these things as I was verbally explaining you, you'll be able to manage any question asked on money laundering. Sorted? Let's move on. Now, if we get in our exam a business risk question, then how are we supposed to write it? Business risk, usually I'll just give you an example, some examples of business risk. Business risk can include, for example, if there is competition. So competition is there. So you'll tell, if competition is there, how is it a risk to you? It is a risk. Yes, we keep the records for 5 years. It is a risk to you because, of course, competition means that the people might go to substitute suppliers to substitute. So that means I might lose the customers. So loss of customers is possible, which will, of course, lead to loss of revenue. So it might impact my going concern. Correct? So in business risk, you have to like analyze it completely, decode that risk completely, that how it is, loss of market share through that. So you have to totally dissect that risk and reach to the worst point from competition, substitute, loss of customers, loss of revenue, and going concern. Right? Then what do I have is another point of business risk. For example, uh, what can we say? Business risk. So loan, which was taken. So already you have, what does a loan suggest? That your gearing will increase. So gearing will increase. So that might actually breach your debt covenant. So if that covenant is breached, then you might have to repay the loan immediately. And if you repay the loan immediately, you actually might have to like face some liquidity problems. And in that case, if this happens with you, the liquidity problems, again, you will have going concern problems. So this is how you actually explain your business risk. So like that, you will have a lot of business risk, which you will identify from the question. Give me some example. Loan is one such thing. For example, if my current ratio from analytical procedures I get to know is below the ideal ratio, or I have a negative cash balance, that means I have an overdraft. And over and above that, I also take a loan. So that's a bad thing to the part two, right? Then, for example, if we have single supplier, so if single supplier and that too the supplier is from abroad, we are importing. So that will also lead to some business risk because what if that supply chain is disrupted? So you'll have to face some difficulties. And then if I talk about your like business risk, for example, you are planning foreign expansion, so the risk associated with foreign expansion is what if it fails? What if it fails? And this expansion will cost you a lot, and that will be a cash drain to the business. Then maybe we have a significant expense on advertisement. So if you have heard about many businesses, they spend a lot of money on meta ads. So I've not tried it yet, but maybe sometime I'll try. But they do spend a lot of money on meta ads, and that is a significant expense. And if you spend a lot on advertisement, what if it does not reach, it does not give desired results? So that would be a cash drain to your business, right? Because meta ad means that you have to give this money to the meta, and if you don't have that money, you will be screwed. Then what else? There will be compliance risk also. That if the company has a lot of compliances in future, for example, it is a industry in which we work is pharmaceutical. So there are a lot of compliances where a license might get cancelled because of any non-compliance. So license might get cancelled because of non-compliance, and this will lead to compliance risk, loss of reputation, right? So all these things, loss of reputation, even our brand might get impaired. So all these things will lead to loss of customers in general, legal claims, yes. So all these things are a problem to the business. So this is like I've just given you an essence of business risk which you might find in a question. Correct? So this is how you actually explain a business risk. You talk about these words and you show its effect and how does it impact your business. Then what else we can say? How to write ROMM and audit risk questions now. Now, what is ROMM and what is audit risk? So, ROMM includes inherent risk plus control risk. Audit risk includes inherent risk, control risk, and detection risk. What is detection risk? For example, there's a new audit line, there's a detection risk. For example, if I don't have enough resources, detection risk. For example, if I have not used enough time to audit this client, detection risk. So audit risk includes all these things, inherent risk, control risk, and detection risk. So how I'm supposed to answer my risk questions? First of all, I need to set a materiality level. So materiality level mostly is given in the question, that you will base the materiality on PBT, on revenue, or you will base the materiality on, let's suppose, you'll base it on uh, your assets, correct? So you will calculate the threshold. So what is the threshold for materiality? Come on, quickly tell me the threshold for materiality. How many of you know the threshold for materiality? So for revenue, half to 1%. So half to 1%. Then for PBT, it is for PBT it is 1 to 2%. Yes, or 5 to 10%. PBT it is 5 to 10%. And then for total assets, 1 to 2%. correct? So this is what we have as our materiality level. Now, if they have given us the materiality to be based on one of these, correct? So I will just keep the materiality. If the risk of the client is high, materiality is kept at the lower end. Materiality is kept at lower end. If the risk is low, risk is not so high, then we'll keep the materiality at higher level. So that is what you do. That's how you decide which materiality you will keep. Then after writing the materiality, what is your like further way forward? So for each audit risk which you identify, first you talk about its materiality, whether that particular account balance is material or not. Then you further talk about its treatment as per the IFRS. So for knowing the treatment as per the IFRS, you should be good in your SBR. If you're not good in your SBR, please refer to my grand revision of SBR. Okay. You can see the recorded version of it. No need to attend it live. See the recorded version. So treatment is coming from the grand revision of IFRS that is already being done lots many time on my YouTube channel. Just check out previous attempts grand revision. I think it was on a blackboard. You will see it clearly. It was in the March. So I'll share the link in the description once again. So make sure you subscribe to the channel, okay? And you get to know the like upcoming videos as well. Like tomorrow we are having a June pre-mock coming out on the channel. So make sure that you are subscribed so that you get the notification. So treatment is to be talked about. Then you need to talk about the risk. That what is overstated, what is understated. Come on. So by writing this, you just don't get done with your risk. You're supposed to tell that, okay, let's suppose there was a account balance of PP. So you talk about its materiality first. Then you talk about how it should have been treated as per relevant ISA or IS. So IS 16 applies to PP. Then the risk is that maybe we've not depreciated it correctly. So maybe it is overstated. So that is when we write the risk. So this is our strategy to write audit risk answers. So I can't emphasize further on it because it is all coming from IFRSs. So please go and watch the revision of SBR on my YouTube channel so that you get hands-on like knowledge of IFRSs if you have already forgotten your SBR. Okay. So this is how you write your audit risk. Now, how to write procedures? That's the next question. How to write procedures? Procedures are based upon assertions. What are assertions, guys? What do I mean by assertions? See, assertions are simply promises made by the management. Promises made by the management. So that assertion from statement of profit and loss perspective, what I need to check is whether that income or expense have actually occurred. Okay, so I need to check its occurrence. Yes. Then what you have is after occurrence, you have to talk about its cutoff. Are you including the revenue in the right cutoff? Then you talk about your like classification. Have you classified that expense and income correctly? Then you talk about completeness. Have you completely recorded the expense? So for that, you obtain the schedule of the cost so that you ensure that you completely recorded the cost, right? So obtaining the schedule. So occurrence, cutoff, classification, completeness. Then we check the accuracy of that expense or income. Then we check its presentation. So you can remember this as OC3 cap, right? So O 3 times C and AP, OC3 cap. Then what we have is from statement of financial position perspective, balance sheet perspective, we have REVAC. So what is REVAC? REVAC is when I check the asset, whether its rights and obligations exist, correct? And based on that, we have some, we need to check the existence also. We need to check its valuation also. We need to check its accuracy. And once again, we need to check its classification. So for example, if they ask you to build some procedures, uh, let's see, let me show you some procedures that I have made actually during my Super 20 classes. So I'll just take out some Word file in front of you so that you can see my answers of the audit risk. See, this is day 3 of my Super 20 that I held with my students. So I can just try to show you. Yeah. So here we just have evidences. Yeah. See, this is how I write procedures. So, for example, I was writing these procedures for the brand which we have purchased. So, obtain the purchase documentation to verify its cost. Discuss with the management why they are not amortizing the brand to understand their assumptions. Then discuss with the management their assumptions of not impairing the brand given the indicators. Obtain the written representation for the valuation of the brand. Obtain the working paper of impairment review to assess the accuracy. So what I'm doing is, how am I actually making my procedures here? How am I making my procedures? Let me just show you that. The ingredient is, first I talk about the verb, right? Then I talk about the, I talk about, if I say obtain, if I say revalue, if I say recalculate, if I say review. So that is a verb. So verbs can be A, E, I, O, U. Analyze, inspect, inquire, understand, observe, recalculate. So verb is taken first. Then on what are you conducting that verb? Obtain what? Which document? Which document do you want to obtain? So on which document, for example, if I say obtain board minutes to assess whether the authorization was there or not, then why are you obtaining what you are obtaining? Why are you recalculating what you are recalculating? If you say recalculate the depreciation to, to verify the mathematical accuracy. So why is basically the assertion. That assertion which I talked about, that is statement of financial position, rights and obligations. So if I say physical verification of property, plant and equipment, I should check its existence. Correct? So for physical verification, I will check its existence. So physical verification of property, plant and equipment to check the existence. That would be my procedure. So this is how you frame your procedure. Correct? So you all can refer to the notes or you can check the procedures for each and every standard. So that is, I believe you must have done it by now. So I've been teaching this again and again. As since I've started teaching audit, I've been telling this again and again on my YouTube also, that this is how you frame procedures. Then when I talk about evidences, what do I write for evidences? For evidences, again, I tell which document should be there. Which document should be there in the working papers and why? Like, what does it reflect? So if I say evidence for depreciation, so I should have working papers of the management to assess the accuracy of depreciation. I should have written representation. So written representation should be there in my working papers to confirm the life of the asset on whose basis the depreciation is calculated. If I talk about a brand that was purchased, so it's purchase document, property, plant and equipment's purchase document, ownership title document. That is an evidence. So evidence is a document, procedure is a verb. So this is how you write your procedures and your evidences. So I hope we all are clear on this. Can I get a quick confirmation? Are we guys clear on this? Evidence and procedures? Yes. Come on, quick. Okay. Next comes once I have planned the audit, when I was in my audit risk stage, I was just planning the audit. Once I've planned the audit, I have conducted procedures. That means I've done work on my client. Then I've also collected sufficient and appropriate audit evidence related to that particular account balance. Yes, Rani, you have to learn the details of IFRSs, but not write the details of IFRS in procedures, not at all. So once I've done all this, next comes the review stage of audit. So in the review stage of audit, first thing that we review is subsequent events. First topic comes as subsequent event. So what is the auditor's responsibility with regards to subsequent event? I will draw a line in front of you, timeline. So our year started on 1st April. It ended on like 1st April 2001. It ended on 31st March 2002. So this is the reporting date. Your financial statements are issued, let's suppose, on 31st December 2002. This is the date of financial statement being issued. Now, your audit report was signed somewhere here. Your audit report is signed here. So, financial statements are made on this date. Audit report is issued on this date. Financial statements are issued on this date. So, what are the responsibilities of the auditor in all these situations? So, how do we define it? Okay. So, we say between before the reporting date, there is no subsequent event. So, I'll talk about after the reporting date. So, between the reporting date and the date of audit report being signed, the auditor has the auditor has active responsibility. The auditor has active responsibility to identify any subsequent event, any subsequent event and look for its accounting treatment, discussing with the management if it is correctly dealt for or not. If it is not, then of course you'll modify your audit opinion. Then after, like the audit report is signed. So after audit report is signed, auditor has passive responsibility where if where if the management contacts or management uh, tells the auditor about a significant event, about a significant event. Instead of tells, you can use the word informs. If management informs the auditor about a significant subsequent event, then the auditor is supposed to discuss and confirm its correct accounting treatment in the financial statement, correct accounting treatment in financial statements. Now, if the financial statements are not corrected, then the auditor might consider reissuing the auditor report. See, if the management does not agree with us, we say the subsequent event is adjusting, and the management says no, it is non adjusting. So, in that case, we might actually modify our audit report. We will reissue our audit report. Then, once financial statements are issued, auditor has no responsibility. Auditor has no active responsibility However, if by chance auditor gets to know any such event which impacts the financial statements materially, then the auditor might actually, the auditor might actually perform the work, further work on that event and discuss it with the management. It with the management. So maybe he will ask the management to actually reissue the financial statements or reissue his audit report. So he has different kinds of responsibilities in three scenarios. In one, he has active responsibility. In another, he has passive. In the third one, he has no responsibility still. Even in the face of no responsibility, he still has some responsibility, right? So subsequent events is basically related with IS 10. So you all know what is adjusting event and what is non-adjusting event. So adjusting event is when we have like there was some evidence that this event might happen after the reporting date, but you never paid attention to it. Non-adjusting event is that no evidence existed uh, on the date of, you can say, this reporting date. There was no evidence that this event would happen. For example of adjusting event, if the inventory value falls, so you should have checked the inventory value as per IS2 whether it was lower of cost in NRV or not. Non-adjusting event, fire at the client's place. That is not something that you guys can actually predict. So that is non-adjusting event. Then going concern review. Come on, what is there in going concern review? So you should know what are the indicators, first of all. We all should know what are the indicators of threat to going concern. So indicators are, how can you say a company is having uncertainty regarding going concern or totally not a going concern? We can say, for example, negative cash balance, breach of debt convenience, breach of debt convenience, then maybe bad current ratio, bad current ratio, then maybe liquidity ratios are worst. Then what else can be there? Give me some other indicators of going concern. Net liability position, etc., etc. So these are some of the indicators of going concern problems. Over trading, yes. Tax payment is delayed, increase in revenue, but profits are decreasing. Key management personnel left. True that. So now once you have this, what is your responsibility as an auditor regarding going concern? So you need to see that first, as per IS1, if there is uncertainty regarding going concern, we are supposed to disclose it in financial statements, right? And this is what we do as per IS1. If the going concern is an incorrect assumption, then what is our accounting treatment? The accounting treatment is one, prepare the financial statements on breakup value basis. What is breakup value basis? Where you include all your assets and liabilities at net realizable value. And also give a disclosure. Now, how would anyone in the world know that you've prepared the financial statements on breakup value basis? So you need to disclose as well. This is the accounting treatment, okay? This is not the auditor's treatment. This is accounting treatment, which auditor will expect to find in the financial statement. So if there is uncertainty, that's one situation. Second situation is when the assumption of going concern is wrong, right? Now, what the auditor should do? Auditor will have various outcomes. If uncertainty regarding going concern is correctly dealt in financial statements as per IS1. That means you've correctly disclosed it as per IS1. Then what you will do, if you have correctly disclosed it, you will make MURGC paragraph. What is MURGC paragraph? Material uncertainty regarding going concern. So here it is a positive para where the auditor draw users attention, where the auditor draws users attention to the uh, correctly disclosed uncertainty in the financial statements. So this is like, if everything was correctly dealt by the accountant, the auditor will do nothing. He will not modify his opinion. He will just add an additional paragraph in his audit report, that is MURGC paragraph, right? And he will give unmodified opinion because he will not, of course, modify his opinion. So unmodified opinion in the audit report. Now, if the uncertainty is not correctly dealt with, then auditor will issue modified opinion. Yes. And this modified opinion will be qualified modified opinion. Most of the times it is a qualified opinion because it's an uncertainty regarding going concern and not an actual incorrect assumption of going concern. So qualified opinion is given, and what do? You give the reason, the basis for opinion, qualified opinion. Yes. So this is what you do in case of when uncertainty is not correctly dealt with. Then if I talk about incorrect assumption, if the going concern assumption was not true, but was correctly accounted for and disclosed in financial statements, then what will the auditor do? He will put it in emphasis of matter paragraph. So he will put an emphasis on the disclosure note, which says that financial statements are prepared as per breakup value basis. Yes, so he will put it in emphasis of matter paragraph, because you just want to draw the user's attention to the fact that, there is something which is emphasis of matter paragraph, where we will just, it's a positive paragraph once again, where you just tell them that, okay, there is some kind of disclosure which says that financial statements are prepared as per breakup value basis. So we just draw the user's attention to that paragraph, to that disclosure note, and you give unmodified opinion if it was correctly dealt for. Now, if it was not correctly dealt for, if the going concern assumption was not true and incorrectly recorded and disclosed in financial statements, then what are you supposed to do? You're supposed to give adverse audit opinion. Why adverse audit opinion? Come on, tell me why adverse audit opinion? Because this is a pervasive misstatement. Since, why it is pervasive? Since breakup value basis impact all the account balances. So it's a widespread misstatement. So it impacts a lot of account balances. So it's a widespread misstatement. Then if, what else? The disclosure. Also, the disclosure of IS1 stating that financial statements are prepared using breakup value basis is fundamental to users' understanding. So even that is pervasive. So we give adverse opinion, correct? And in addition to adverse opinion, you give basis for adverse opinion. So this is what you do for your going concern. Are we guys clear on it? Adverse audit opinion is issued if it is incorrectly dealt with in the financial statements. So I've given you four situations. If uncertainty regarding going concern is correctly dealt, that's situation number one. Then you give just MURGC paragraph and give unmodified opinion. So you give MURGC paragraph and you give unmodified opinion. Okay. And if uncertainty is not correctly dealt, then what you do? You give modified opinion and basis for qualified opinion. Then if the going concern assumption was not true, if going concern assumption was not true, but you've correctly prepared and disclosed the breakup value basis, then you just give emphasis of matter paragraph, right? And you give unmodified opinion, correct? Then if the going concern was not true and incorrectly recorded, if going concern was not true and incorrectly recorded, then what you do? Then you simply give adverse audit opinion, first of all, because it's a pervasive misstatement, and you give basis for adverse audit opinion. Yes. So this is what we do in case of going concern. Now let us quickly discuss what goes into an audit report. What goes into an audit report? So what is the name of your friend? The name is Tao Cora Reed. Reed is time pass. I'll not write it. Tao Cora is the name of your friend. Maybe he's a Malaysian friend, let's suppose. So what is the T stands for? It's the title of the audit report. A stands for to whom it is addressed. So addressee. Then O stands for what is your audit opinion. Then B stands for basis for audit opinion. Then K stands for CAM paragraph. So in a listed company, CAM is necessary. O stands for the other information paragraph, right? And R stands for what is R? What is R? Responsibilities of the auditor? Responsibilities of the auditor? Yes. And responsibilities of the management, first of all. Then responsibilities of auditor. Yes. So this is what goes into the audit report. So this is basic, I would say, this is the basic format. So what I have to do is, once my opinion is modified, now what all kinds of opinion do I have? What all kinds of opinion do I have? I have number one is the qualified opinion. Second is the adverse opinion. Third is disclaimer of opinion. So when do I give qualified opinion? I give a qualified opinion if the misstatement is just material. Okay. I give adverse opinion if misstatement is material and pervasive. I'll tell you what exactly pervasive is. I give disclaimer of opinion if there was lack of evidence and pervasiveness. So if there was any lack of evidence and the misstatement was pervasive, right? So this is what we do for disclaimer of opinion. Now, what in the world, we all know what is material. We considered what is materiality and the thresholds. What in the world is pervasive? Pervasive is any misstatement which is widespread in the financial statements, widespread in financial statement, that is, it is not restricted to just one account balance or transaction or disclosure, it is widespread. Then, if not widespread, then any misstatement which is a proportion, significant proportion of the profit, revenue, or asset. That means 60% and so it is greater than that. So that is what we call as pervasive. It is a very huge misstatement. Or it is related to a disclosure which is fundamental to users' understanding. Fundamental to users' understanding. I have two examples for such disclosures. One is, okay, one is your related party transaction disclosure, which is fundamental to users' understanding. Second disclosure is disclosure related to breakup value basis, which we just read. So in this case, we say that this is a pervasive misstatement. So if I have not correctly disclosed this thing, this is a pervasive misstatement. If it is a pervasive misstatement, I'll either issue adverse opinion or disclaimer. If sufficient evidence was not available, then I'll issue disclaimer. Otherwise, I'll issue adverse. So we all sorted on the types of opinion and what is pervasiveness. Let's come back to the audit report now. So once I have stated my opinion, see, the original report has unmodified opinion. Now, if you change your opinion, for example, you make your opinion as adverse opinion. So you make your opinion as adverse opinion. So you will now explain, not onion opinion. Okay. So you will explain in basis for opinion that what exactly, that why you have such an opinion. What was the misstatement? So you'll explain the misstatement here. Explain the misstatement. So why do you think this is an adverse opinion? Like what was the materiality and pervasiveness of the misstatement and why this misstatement exists and why is it like wrong? So you need to tell that. Then CAM, key audit matters. What is key audit matters? Let us discuss that. What is CAM, EOMP, OIP, OMP, and MURGC? Yes. What is CAM? Let's talk about it. Before we talk about CAM, we should know what matters are actually communicated to TCWG. So what do you communicate once you complete your whole audit process? What do you communicate to TCWG? You communicate the auditor's responsibility to the TCWG, that, you know, I was responsible for these things, but that does not mean that TCWG's, you can say their responsibilities are diluted. If we tell them that we were responsible for the risk of material mistake, that does not mean that they are not primarily responsible for the preparation of financial statement. Then we tell them what was the scope and timing of the audit. We tell them the significant findings from the audit. So for example, if any information was delayed on their end, or for example, there was some significant event which happened or a misstatement, material misstatement which is there. First, you communicate it to TCWG, na? So maybe sometimes TCWG agrees that yes, there's a misstatement. They rectify the misstatement. Then you don't actually modify your audit report. You don't give an modified audit opinion. So you talk about significant findings from the audit, and then you talk about auditor's independence. Now, out of these matters, the areas which you think are of highest risk, the area which are of highest risk, they are key audit matters. So what is CAM? Not scam, it is CAM. CAM is issues out of the communication to TCWG, which is considered as highest risk areas based on auditor's judgment, based on auditor's judgment, are considered under CAM. You should always keep in mind there should be no repetition. Why no repetition? That means if you've put something under MURGC, that should not come under CAM. If you put something in emphasis of matter paragraph, that should not come under CAM. So there is only one time we refer to one event in our audit report, right? Then secondly, we should also know that once the CAM is being disclosed, we should know the placement of CAM. So where is the CAM paragraph placed? It is placed after, it's Taub Cora read, right? So it's placed after basis of opinion. So you should know that. So what goes into CAM is, you should explain, first of all, placement is after basis for opinion. Then what goes into CAM? Why it is, what is CAM, and why do you consider it as key audit matter, and how was it dealt? How was it dealt? Was it dealt in the audit? Dealt in audit. So you are supposed to tell what matter do you, yes, CAM comes for only listed companies. So what is CAM? That you need to tell that I identify this as a key audit matter. Why do I think this is a key audit matter? And how was it dealt in the process of audit? That is what I do for CAM paragraph. Correct? So this is what is CAM. Then let's talk about EOMP, emphasis of matter paragraph. No repetition means, Adrika, that if I have already put an issue in emphasis of matter paragraph, I will not again put it in CAM, and vice versa. If MURGC is there in the MURGC paragraph, you don't also put that as key audit matter. So once you've placed something in the audit report, you don't repeat it. Now come to what is emphasis of matter paragraph. So emphasis of matter paragraph is basically where we draw the user's attention to correctly recorded or disclosed account balance or transaction. For example, we just refer that please refer to this note where we have talked about uncertainties regarding going concern, or please refer to this note where we have talked about that we've used breakup value basis. So it is like you draw the user's attention to a correctly recorded thing in the financial statements. So we don't talk about misstatement here. So it's a positive paragraph, right? We don't, I'm writing it for your note, not, don't use the word we in the exam. We don't talk about misstatements here. Correct? We don't talk about the misstatements here. So this is what is going into EOMP. Then what we have is other information paragraph. So other information paragraph is when we talk about other information like chairman's statement, like CEO's statement. So all these things are like other informations. So we need to tell them that what is the auditor's responsibility regarding, in this paragraph, we talk about auditor's responsibility regarding other information. And we also tell if we find any inconsistency in other information. So originally, where is other information placed? Title, addressee, opinion, basis, CAM, other information. See, if there is no inconsistency in other information, that means the qualitative information given by the in the annual report. So if you find no inconsistency, no false claims in that, then you let the OIP paragraph be placed after CAM. But if there is any inconsistency, then this OIP will move from here to here. Correct? OIP will move from here to here. From after CAM to after basis of opinion. Do we understand this? If there is no inconsistency, OIP will remain here. But if there is an inconsistency, OIP will move from here to after basis for opinion. Correct? That is what we mean by other information paragraph. Then what do we have? Just take note of it. If there is no inconsistency, then no inconsistency, then OIP remains after CAM. However, if there is an inconsistency in other information, then the para moves, the para moves from after CAM to after basis for opinion. Yes, that is other information paragraph. Then what we have is other matter paragraph. What is other matter paragraph? When we talk about other matters like previous year's financial statement was not audited. That is one classic example of other matter paragraph. Or you talk about the previous auditor or something like that. That is other matter paragraph. So it is not necessary to add OMP if there is such a matter which exists where you want to don't emphasize, but it's just like it's an okayish matter, not related to financial statements, but related to some like general thing which you want to disclose to the users of the report. So you will put OMP. So where do you put your EOMP and OMP? So if the name of your friend is Tao Kora, where do you put your EOMP and OMP? Where do we place EOMP and OMP? We place it here. So MURGC also come after basis for opinion. Yes. Where is MURGC placed? MURGC is placed here. Where is emphasis of matter placed? Here. Where is other matter paragraph placed? Here. Right? MURGC is placed after basis for opinion and EOMP and OMP is placed after CAM. So guys, whenever the name of your friend changes, your audit report is modified. So title of the report changes as modified report. So when you actually add MURGC paragraph, the name of the friend changes. So if the name of the friend changes, the report is modified. If I add emphasis of matter paragraph, the name of my friend changes, again audit report is modified, even if the opinion is unmodified. If I add other matter paragraph, the audit report is again modified, even if my audit opinion is unmodified. So this is something that you need to memorize. And if, of course, the opinion changes and no paragraph is added, then also the name of the friend changes, because then you put adverse opinion and then you put the heading as basis for adverse opinion. So you should know this for a requirement where they ask that critically appraise an audit report. So you should know the placement of it. You should know the content of it. You should know whether it is the correct thing that is being included in the correct paragraph. The placement is right or not. Right? So this is what we keep in mind for our audit report. So we are kind of done with our audit report and the kind of paragraphs we have. So just give me a confirmation. Are you guys clear on all this? Are we all clear on this? Yes, it does change with OMP as well. Okay. That's voluntary amnesia. There's no hard and fast rule for that. Yes, whenever the name of the friend changes, either due to addition of any paragraph or due to modification of opinion, the report will also change. Now let's move forward. How do we rely on work of others? So, for example, how to rely on the work of component auditor. I'm talking about group audit situation here. So, in group audit, first I need to determine whether the component is material or not. So, how do I decide it? I would decide it maybe it's material by nature. The component, that means the subsidiary, is material by nature, or I need to see whether it is the assets of the component are 15% or higher, 15% or higher than group assets. So in that case, it's a significant component. So once you've identified that the component is a significant component to you, it's a material component to you, then you are supposed to, if a component, if it is a significant component, then what are you supposed to do? You are supposed to check, either you will perform full audit on the financial statements of the component using component materiality. Yes. And or what you can do is you can perform specific audit procedures. You can perform specific audit procedures on identified risk of material misstatement of the component which you have, subsidiary that you have. Or what you can do is, as group auditor, you can either do full audit or specific audit procedures on risks which are identified as risk of material misstatement. Or what we can do is we can have a like audit done, substantive procedures, or you can say audit of specific account balance, transactions, or disclosures, which you deem are like high risk areas in that company. So this is what you do in case of significant component. So do you rely, how to determine whether I should rely on the work of component auditor or not? See, if I'm doing full audit, that means I'm not relying on the work of component auditor. If I'm doing specific audit procedures on ROMM, then I'm up to some extent relying on the work of the component auditor. If I'm doing audit of specific account balance, again, I'm relying on the work of component auditor. So how would I determine whether to rely on the work of the auditor or not, the component auditor? I would see what is the competence of the component auditor, which code of ethics is he following, then is he independent? Yes. And I can actually perform, or I can see the internal controls which this component auditor has in place. What are the quality control measures it takes? Yes. So these are the things that I can actually, yes, experience. Competence includes experience. So these are the things that I can check for the component auditor before I place any reliance on component auditor. Correct? Similarly, how to rely on the work of internal auditor? So if you are an external auditor, can you rely on the work of internal auditor? You need to see what is the status of auditor in organization. That means, is he considered as a senior person? That means, does he have any kind of independence? Like, will anybody listen to that internal auditor in the firm? Then we need to see independence of him. Like, is he too much dependent on the firm? Maybe by his fees, maybe like he can be laid off by the company. So is he independent? Is his objectivity there? Like, his objectivity is not compromised. And what is the approach of the auditor, of the internal auditor, and what quality control measures again he has in place. So these are the things that you consider when you rely on the work of an internal audit. Now, what things do you consider when you rely on the work of any service organization? Now, what do I mean by service organization? Service organization means when I am outsourcing important operations to firms, like client is outsourcing them. So in this case, what I see is, what is the materiality of the outsourced function? Materiality of outsourced function. Let's suppose I've just outsourced a very immaterial thing like grocery. So what is the materiality of the outsourced function? Then can I access, what is the accessibility? Can I access, or do I have access to the service organization? So if I want to count inventory, can I go to their warehouse and count the inventory? That means, do I have access to the service organization? Then what is their control risk? To assess their control risk, I can actually get type 1 or type 2 report. What is type 1, type 2 report? Type 1 report is basically when you just talk about the design and implementation of the control. So what design do they have of controls and how do they implement it? When you get a report from service organization on their design and implementation, that is type 1 report. Type 2 report is when I talk about design, I talk about implementation, and I talk about the operating effectiveness of those controls, operating effectiveness of those controls. So this is basically what I mean by type 1 and type 2 report. So to check this, I can get these type 1, type 2 report, that what kind of control risk do we have in the outsourcing firm. Then further, I can check their experience. Experience. Yes. Then what else we can do is, we can check whether they have any compliance with laws and regulations. So do they follow those compliances or? So these are the things that we consider before we rely on the work of service organization. Then what do we do when we have to when we have to do some work on opening balances? See, I've just given you a gist of it. I'm not giving you the correct, like the whole sentences. I'm just giving you the keyword so that you remember it. So when I am doing some work on opening balances, first of all, I should check the most recent year's financial statements and make sure that what I have brought forward in the current year was correct figure, because most of the times we make the mistake in carrying forward, like brought forward. So recheck that brought forward amount for accuracy. Then previous years, like audit report, check the audit report. Was it do you have an auditor previous year? So if there was an auditor and he's given an unmodified opinion and that auditor is reliable, you've received your professional etiquette letter. So in that case, you will say that yes, I can rely on this and I can say that less work will be performed on opening balances. Then need to see that whether my opening balances are like having consistent accounting policies. So like from previous year to current year, I should consistently apply my accounting policies. Again, that has to be seen from previous year's financial statements and it is reflected in accounting opening balance. I need to make sure that previous year, the opening balances that I have from previous year, they were I've received them by the application of IFRS. Because in many cases, last year we were applying something else. This year we are applying something else. So application of IFRS is very important. Then disclosures, again, the disclosure should also be appropriate from the previous year to current year. So this is what you see in the opening balances. And this is like, just remember the gist of it, the keywords that I've given to you. Now comes the forensic investigation and procedures to accept. So this is something like, I think other assignments, every other assignment is important. Whether I talk about due diligence, whether I talk about prospective financial information, whether I talk about anything else like, forensic investigation or performance audit, everything is important, but forensic investigation is a little more expected to come. I don't know why, but I feel so. Just a gut feeling. I don't have any data to back this up. But forensic investigation, kind of, I think it might come up. So you should know what are the procedures to accept forensic investigation. So when I talk about forensic investigation, I'm acting as an expert witness, right? So I have a legal liability that I will be investigating into a fraud. I will be quantifying a fraud. I will be looking into what loss has occurred to a company due to that fraud. So I am into a very important position. So first I should see whether I have experience, whether I have knowledge of this or not. Then I must see whether who is the user of the report. Because if the user of the report is like law, court of law, then my professional liability increases. So I need to make sure that I know that who is you going to use my report that I prepare out of this forensic investigation. Then do I have enough human resources before I accept this like client? Do I have enough human resources? That is what I need to consider. And like competence, knowledge, who's the user, human resources, and risk profile of the company can also be considered before accepting the client. Then what is the work to be done? What work is done in a forensic investigation? You look at the nature, okay, and you look at the circumstance of the fraud, and it is like case study to case study, it depends. So if a fraud is related to payroll, for example, there were ghost employees which were added into the balance sheet or the P&L, and that has led to outflow of cash. So there was a theft of cash in the name of ghost employee. So in that case, I will gather sufficient and appropriate audit evidence, and I will try to identify the preparator of fraud. That is my sole motto. I need to find who's the preparator of fraud, who has committed this fraud. And after identifying who has done this, I need to identify why he was able to do it. So I need to see which controls are weak, which led to this fraud. Then I need to quantify the loss which the client has occurred because of this fraud. So I will perform procedures. For example, if there is a ghost employee, so maybe I can check the bank statement, verify from the bank statement that you know from to which bank the money is going in the name of ghost employee. And yes, you can also consider fees here. Of course, that's relevant. So I will check that to whom that money is going. Then maybe I can actually do physical verification in terms of employee count. So I can randomly visit the client someday and count the employees and see the payroll sheet and what is the number, and I can find the discrepancies and then work on them. That is forensic investigation, right? So that's how you perform forensic investigation into a fraud. Now that depends from case study to case study. Okay, I cannot give you generalized procedures here. It will depend upon whether it's a payroll fraud, whether it's an inventory fraud. So all in all, what you need to do is you need to apply your skepticism. So most of the times in fraud, you need to apply skepticism. This is general point. And you need to find the nature and the circumstance of the fraud, who committed it, why he was able to commit it, like what are the internal control weaknesses, and you need to collect sufficient and appropriate audit evidence, and you are supposed to submit a report which will be given to court of law. So you will act as an expert witness in the court of law with regards to that fraud, right? So this is what we have to do for our forensic investigation. Now, guys, lastly, few topics, and I believe I'll take this session up till like few more minutes because I need to talk about these two technical articles, or we call them as current issues in audit. Very small yet effective topics. After that, if time would allow, I will also take up acceptance procedures, like how do you accept the client, rules of advertisement, tendering, all those things. Okay. So sit straight. Okay. Few more minutes to go. Don't give up. Keep your focus there on the screen. Are we all in? Have a glass of water. Are we all in? Yes or no? Come on. SAEE is sufficient and appropriate audit evidence. Awesome. Let's now talk about big data. What is big data? See, when I say big data, it is like in general, it is a set of data which is scattered, which is unstructured, correct? This is what we mean by big data, but it is having a lot of information. A data which is in high quantity and it is unstructured, it is scattered. And how can you use it for your benefit as an auditor? I would say it is a sophisticated uh, computer assisted audit technique. From your F8, you must remember computer assisted audit technique. So when as an auditor, we are actually auditing any client, we use many techniques, where many softwares, I would say. You don't actually take one invoice and audit them. You have softwares, you use AI, you use data. Big data means a set of data which is huge, which is scattered, which is unstructured. So you use that data into your software so that you can draw analysis, so that you can draw analysis. Now, this analysis is very fruitful to you because this will help you to reduce the risk of material misstatement, and this will also help you to save time. Correct. So big data is something what can be asked to you is how big data helps the auditor. So auditor is helped in a way that he can use this unstructured data into computer assisted audit technique by structuring it, by giving it a meaning. Auditor can draw conclusions. Okay. So auditor can draw conclusions based on this data. So even if I talk about your, I usually say this, if I talk about your enrollments at TG professionals. So if I have PayPal, for example, from outside India, I'm receiving payments via PayPal. So PayPal also tells me that Tashwita, you received this much payment from this country, this much is payment from this country. So that is like giving me an analysis. PayPal has big data. It has a huge set of data, but it has created a pie chart out of it, giving me a proper analysis that this money is coming from Zimbabwe, this is coming from Mauritius, this is coming from Dubai. So that is kind of analysis which can help auditors to draw conclusions. And it will also save the time of the audit, right? And since it is based on technology, the risk of human error reduces. Human error reduces. Now imagine you are you are sampling some invoices versus an AI tool is sampling it for you. I write description of YouTube via myself. I do so many word spell errors on the word file. I would do it on the description also. But imagine doing it like imagine getting it on the description and versus chat gpt. So if I use chat gpt, I would not do those typos, right? Those spelling errors. So human error reduces because with the help of big data, you are able to apply computer assisted audit techniques which saves your time, and the risk of human error reduces, and you're able to draw conclusions which are like based upon technology. Correct. Now what are the disadvantages? This big data also has some disadvantages, which is why this is a very important topic, because in these days AI is at its peak. I won't say at peak, but it's sort of rising. Like suddenly it has come into the picture. The AI for even PPTs, the AI for video editors are losing their job, graphic designers are losing their job, content writers are losing their job. Soon the content makers will also lose their job because there is an AI through which you can make videos also. So what are the disadvantages of this big data and the process of audit? Can you give me some disadvantages? Yes. What are the disadvantages? Leakage of data. So if you have a lot of data with you as an auditor, you might leak it. You might have heard about a lot of companies, they say that there was a data leakage, and then you start getting those fraud calls. So your phone number and everything is went to the fraudsters. So now they have access to it, right? So leakage of data is one of the disadvantage. Yes, corruption of data, manipulation is also, you can manipulate it. I mean, data is subject to manipulation. If I'm drawing conclusions on the basis of data, first I can manipulate the source of the data and then I can draw the conclusions. Yes. And then I can talk about cost associated with it. So it is quite costly. Yes. And then I can also talk about what? Non-compliance with laws and regulations. Why? Because if you leak the data, there are some cybercrime laws, you might breach them. And in that case, that might attract some fines, penalties, or criminal proceedings against you. Right? So we might need some people like IT experts in our business who can help us with this. So we are not aware of these things and it is a costly thing. That's why what you should know from big data is what is big data, how it is used in computer, how it is used in audit via computer assisted audit technique, what are the advantages and what are the disadvantages. That's it. Do we all understand this big data? Yes or no? Do we understand this? Okay. Let's check out this technical article, which is basically sustainability assurance, or you can say general requirements for sustainability assurance. This was one of the recently introduced technical article. So here we first talk about that increasingly shareholders, especially institutional investors, are demanding more information so that they can evaluate the impact on organizations' activities on environment and society. So basically, shareholders these days need information about your six types of capital. So you all know from sustainable reporting in SBR, What is sustainable reporting? Sustainable reporting is when we report or we use resources in such a way that these resources are available for our future generations also. Yes. So to maintain our sustainability, we should report in our annual report, we should report the human capital, manufactured capital, intellectual capital, financial capital, the environmental capital. So you need to report 6 types of capital in your integrated reporting. So they're saying shareholders need more information these days. So that means there are some green credentials. So to meet these green credentials, where the entities are giving a lot of information in the annual report, which is related to 6 types of capital. So what the IAASB has done, it has issued an exposure draft. So it has proposed ISA 5000. So this ISA 5000 general requirements for sustainability assurance engagements was issued by IAASB in August 2023. So this is a very recent kind of a thing. In August 23, it was issued. That is the ISA 5000. What is ISA 5000 saying? It says, on issuing the exposure draft, the IAASB commented that this proposed standard will serve as comprehensive standalone standard suitable for any sustainability assurance engagements. Now, these days, shareholders, they just don't want people to, or shareholders don't want auditors just to audit financial statements. They also want auditors to audit this green information which the clients are reporting. Clients are saying we saved the environment, we are giving this much for the education of the children, for poor people. So, the auditors are supposed to check whether actually the clients are doing this or not. That is something which is shareholder is wanting these days. So it will apply to sustainability information. So what we have now proposed is, we have proposed an auditing standard on sustainable information, that how the auditor should actually audit this sustainable report. So the proposed standard is profession agnostic, supporting its use by both professional accountant and non-accountant practitioners. That means it is not just specific to one profession, that is ACCA. Any person who wants to assess whether the client is actually correctly disclosing its green credentials or not can use this standard. So it applies to multiple frameworks. So it applies to IFRS S1 and IFRS S2. You guys have not done this. This is also recently introduced sustainability standards. Previously, sustainable reporting was actually voluntary. Now we have come up with a exposure draft that it might turn out to be real, and it might turn out to be like a mandatory practice. And for that, we have issued already IFRS S1 and IFRS S2. Correct. So what are we supposed to do in this is, the second point to note is that ISA 5000 is profession agnostic. This means that it can be used by any assurance practitioner. So that is, I've already told you, they should adhere with relevant ethical requirements and a system of quality management system which is at least as rigorous as those used by accounting practitioners. Now, is this important? Is this important to know? No. All you need to know is that it is profession agnostic. That means it is not dependent on profession, can be used by professionals, can be used by non-professionals as well, right? All we need to do is they should comply with some code of ethics. And what else? They should have some system of quality management. You all know what is system of quality management now. You've done this, 8 elements, system of quality management. So if that person is having these two things, then only he can apply this ISA 5000. Then moving ahead, what is sustainability? We all know what is sustainability. When we talk about climate, energy, water, biodiversity, blah, 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 human rights, all this is sustainability. Now, what is important is how to apply this ISA 5000. So ISA 5000, that is an exposure draft, can be applied whether the engagement is designed to provide limited or reasonable assurance, and it can be applied to all of an organization's sustainability disclosures. So, what are the objectives of this ISA? Let's read them. Objectives. First objective is to obtain reasonable assurance or limited assurance, which is dependent on the type of engagement that you have signed. Yes, to obtain reasonable or limited assurance as applicable, whether the sustainable information is free from material statement or not. So this is what you want to get. You want to see whether it is free from material misstatement. That means it's true and fair or not. That means the sustainable reporting about human capital, natural capital, whatever this company is doing is true and fair or not. That's your objective. To express an opinion on sustainability information through a written report that conveys a reasonable assurance and describes the basis for the conclusion. So, your objective is to give a report. Like for audit, our objective is to give an audit opinion. Similarly, here also, our objective is to give a report. To communicate further as required by this ISA and any other relevant ISA. So, three objectives are there of ISA. First is to see if it is true and fair or not, to give a report, and to communicate it further if necessary. So, if the company is lying too much, you can actually disclose it to third parties as well. So, these are the three objectives. Now, what is the acceptance of the engagement? How do we accept this engagement? Acceptance procedures. Similarly, like we used to do in the all the things, how do we accept it? We understand the scope of work, the sustainable information to be reported. Do we have competence? You can write all those points again. Do we have competence, experience? Usually, you will not have experience because this is recently introduced. Then the reporting boundary. Is it transnational? That means in this nation only or outside the nation also. Then existence of suitable criteria. So IFRS S1 and IFRS S2 are your suitable criteria using which the financial statements of sustainable reporting are prepared. Not financial statement, but the extra qualitative information is disclosed as per these standards. Then determining the level of assurance to be provided. So what you need to consider is your competence, scope of work, uh, suitable criteria, is it transnational, and what about the level of assurance? So these are the five things that you need to consider before accepting any sustainable reporting engagement. Then planning the engagement. How do you plan the engagement? It is crucial to obtain understanding. First of all, as per ISA 315, you need to understand the whole, the sustainable reporting. The assurance practitioner will need to spend time at the start of the engagement to ensure that they have a good level of understanding of what is being reported, how it is being reported, and this includes understanding relevant internal controls. So, what is reported, how reported, what are controls? This is what you need to learn or understand at the planning stage. What is being reported in the sustainable information, how it is being reported, and what are the controls over it. Then the assurance practitioner must use risk assessment procedures, including procedures related to fraud. Now, in this case, guys, the most important thing is fraud. What can happen in sustainable information? You might say you are giving funds for poor people, but you're actually not giving. So that is a fraud. So you need to see what kind of disclosure they are giving and how they are giving this disclosure and what controls do they have. Like if you say that you are helping the poor, how much money went to the poor? How are you recording it? Is there any control over it? That is what you need to understand. After understanding that thing, you are supposed to make some risk assessment procedures, right? The requirements vary depending on whether the engagement is to provide limited or reasonable assurance. We all know this. So, for example, in reasonable assurance engagements, more work is needed on understanding the system of internal control. So, if reasonable assurance is given, more work is needed. So, if more work is needed, what you will do is you will have to understand the control is placed, like how much money went for the poor people. You need proper control on that. Then, what else? If I talk about limited assurance, then I might just inquire. I might just inquire from the management. I can inspect the management. That is how I give limited assurance. I don't do substantive procedures for limited assurance. Then materiality. Materiality is a significant issue here and it needs to be applied using bifurcated approach. Now, what in the world is this bifurcated approach? This means considering materiality for qualitative disclosures and determining materiality for quantitative disclosures. So materiality for a reasonable assurance is same for limited assurance. However, it is important to understand that organization will have its own materiality process, including double materiality. This means consideration of the significance of the impact of a sustainable matter on the organization, as well as the significance of the impact on the outside world. So that is double materiality concept. Bifurcated materiality is materiality by number, quality by quantity. You all know this materiality is either by quality or quantity. So that is bifurcated approach. Then double materiality is how it is material to the organization. Maybe that amount is very material to the organization, or if they breach it, they will end up maybe having some no clar, which will lead to fines and penalty. So how it is material to organization and how it is material to outside world. That is double materiality. So what are the two words in materiality here? Bifurcated approach and double materiality. So the assurance provider needs to understand organization's materiality process, but this is separate from their own materiality considerations. Irrelevant time pass, forget it. Where the concept of double materiality, that is organization and outside world, is relevant, the assurance practitioner should consider both financial and impact materiality when determining their materiality level. So when you consider this, how is it material to organization? Again, you need to consider how it is important to the organization by its quality and by its quantity, by its nature and by its financial number. So this is how you actually determine the materiality by using double materiality bifurcated approach. Then obtain the evidence. How do you obtain the evidence? When the risk of material misstatement in designing and performing further audit procedures, the requirements vary depending on whether it is a limited. Again, they just keep on repeating the same thing. If it is a reasonable assurance, as I said, how will you obtain the evidence? You will perform work on internal control. So you will perform procedures on internal control. So how I would do it? The assurance practitioner must exercise judgment in evaluating what constitutes sufficient and appropriate audit evidence. Often sustainable information is forward-looking. That means it is futuristic, based on estimates and future plans. So organization produce scenarios based on best estimate or hypothetical assumptions, which might be subject to management bias or great uncertainty. So evidence can therefore be difficult to obtain. So the assurance practitioner may need to exercise significant level of judgment. As said, this is the addition to the evidence which may be required from external experts. So see, it will be varied on the case. Most probably, you will not get a question on this where they ask you a case. They will not ask you an application-based question. I ask you a theoretical question maybe that what is the acceptance procedure for sustainable reporting? How do you define the materiality? How do you obtain the evidence? And how do you report? Four things. So here, you will say everything is very much based on judgment. It is subjective. It is relative. So I need to increase my skepticism here. And it is difficult to obtain the sufficient and appropriate audit evidence in this case. Then how do you report once you have got your evidence? How do you report it? It is important that the users of report understand the level of assurance that you're giving. So kind of assurance that you give for reasonable assurance, the same kind of report you will prepare. If it is limited assurance, then you will give negative report. That means you will start, I didn't find anything which goes against this. So nothing was found, which is suggesting that there is any mistake. So this is what you need to understand from the sustainable reporting point of view. So you can give it a quick read through if you want. But if I just give you a brief of it, what is this? This is all about ISA 5000, which is an exposure draft where you should know what is sustainability. Okay. So they might ask you what is sustainability? What is the objective? What is objective of ISA? So what is the objective of ISA? Objective is to see, to check if sustainable report is true and fair, and then to give report which can be a reasonable assurance or limited assurance. And the third motive is to communicate further if needed. So these are the three objectives of ISA 5000. Then how do you check the materiality? How do you check the materiality? So materiality is basically checked by looking at the approaches like bifurcated approach, where I look at materiality by nature and amount. And then I also go for double materiality. So in double materiality, I talk about how it is material to the organization and then how it is material to the outside world, correct? And then how do you get planning? Like how do you do the planning of this thing? So in this, we look at the risk and we basically, if it is a reasonable assurance, we need to look at the internal controls. And if I talk about its evidence stage, since it is subject to a lot of, you can say, subjectivity, there is a subjectivity involved, there is judgment involved. That means relativity is also involved. So in that case, evidence is difficult. It is difficult to obtain. It is difficult to obtain sufficient and appropriate audit evidence. And if I talk about its reporting, just like we do reporting of reasonable assurance, same way you will do it. If it is negative assurance, then you will do it in a way of like nothing was found. So this is limited assurance, correct? And here again, the auditor should also maintain his ethics a lot because this is green, like green credentials, right? So this is like there is a risk of fraud. So here the auditor is also not supposed to just think about the organization as it is something related to, I can say, world at large. So auditors' ethics become more important in this case. Plus, this is also subject to a lot of manipulation, subject to a lot of manipulation. And it is difficult, it is difficult, it is difficult for anyone to question the auditor because this is a qualitative thing, na? So it is difficult for anyone to question the auditor. So in this case, auditor should be very much specific about his ethics. He should maintain his ethics a lot because this is not something related to numbers. It's not easy to figure out a fraud in this situation. So fraud in numbers can still be found out. If money was lost, you can find it out. But in this case, it's difficult to ascertain the loss, right? So this is something that you can keep in mind for your sustainable reporting. Now, what is transnational audit? Transnational audit is audit again, across the nation. So if you are doing an audit and it is to be relied across nations, that means people who are investing from abroad will also believe in the audit report that is being issued. So that's transnational audit. So your, you can say, responsibility increases in this case. And if I talk about support letter, what is a support letter? So it is like, for example, parent is supporting the subsidiary. That means subsidiary is dependent on the parent. So to determine subsidiaries going concern, I need to get a support letter from the parent. So parent needs to sign a support letter from TCWG, from a member and those charged with governance. He should properly sign a support letter. I should also see whether parent has the capability to support the subsidiary. So I need to see the going concern of the parent as well by looking at their cash flow forecast. So that is what I mean by support letter. Then you can get a direct question, what is joint audit? When two auditors, when two auditors, they audit one company, that is joint audit, correct? And you should know what are the advantages of joint audit and what are the disadvantages of joint audit. So advantages are reduces the risk of material misstatement, more reliable report, more reliable opinion. Disadvantages are there might be a conflict in their opinion, there might be more cost. It will, increase the cost and the resources being used. Correct? So these are the 30 questions that I wanted to cover with you and I have covered with you. Apart from that, there are acceptance procedures. Like how do you accept your client? What do you look? What is a tender document? What is an engagement letter? So see, all these things, I believe you guys can now manage yourself. Because what is a tender? It's a proposal document, right? So proposal document means that whatever should be included there, your background of the audit firm, what the client needs from you, what will be your fees, your basis of fees, what is your experience, correct? So that is all what goes into the tender. Then if I talk about how do you accept a client? In acceptance, you just simply check whether the client is actually, first of all, having integrity or not. And then you check whether this client is actually reliable or not. And this client is, what are the risky areas of the client? Do you have competence to manage this client? Do you have resources to manage this client? What fees you will charge? Is there any ethical issue? Like, is there any intimidation or self-interest? So all these things are basically there within the client acceptance. Then if I talk about the advertisement, like how should I advertise? What are the rules attached to advertisement? So whenever you advertise as an ACCA, first of all, if you call yourself as chartered certified accountants firm, so 51% of the voting right or the 50% partners of your firm should be ACCA members. Then only you can call yourself as chartered certified firm. Then if you can use the logo of ACCA only if one of your partners or directors is an ACCA member. Then when you're advertising, you must keep in mind that you actually are not giving any false claim. You're not bringing disrepute to the profession. You're not bringing others down, not any person down or not any profession down. And you should not lowball. Lowballing is not prohibited, but it is frowned upon because it compromises the quality of the audit. Lowballing is charging low fees. So these are the things that I think anybody and everybody would try to make up now because you have uh, literally done so much today. So I've literally taught you almost the full audit. I tried my best and as much as I could do in the given time. I hope it was helpful. If it was, please do leave down a comment after attending the session and make sure you subscribe to the channel and stay connected. And maybe you can do that after the exam, but right now, keep studying, okay? Stay connected, and I'll be sharing this Word file with you, okay? And that would be in the description box. So please, guys, I hope it was helpful. Let me know the feedback after the session. Maybe on the WhatsApp group, it's recommended you post it as a comment. And all the very best for your exam, guys. May God bless you all. Keep smiling. Give your exam with full confidence and don't give up. Whenever you find a difficult situation, whenever you find a bouncer question, always keep your mind stable, alert, stable, happy. Okay? What is the maximum loss that you will be or you will give the paper again? Doesn't matter. We need to give the best in this shot. Okay? So don't give up on that question. Don't give up on that bouncer question. Do it again. revise it. Like, try to apply your common sense. If you are lacking in time, give a paper again, do your pre-June mock. Tomorrow we have our pre-June mock, uploaded on the YouTube channel itself. So just go through that and keep smiling. Please don't take too much load. Let it be. Take it easy. It's just a paper. It will pass by. Just think about after giving your exam, what party plans you have. That helps to release the anxiety and the stress. Okay. So all the best, guys. Thanks for watching it till here. I hope it was a helpful session. See you all in some other session someday. Bye bye. Take care. Good night.